Good morning, everybody here in the room and on the live stream. It's my pleasure to open the second day of our annual research conference. I have an important announcement to make. You have won the first prize. The first prize is that we start the session on time, despite the early time. And so we have a session here, which is interesting in terms of a combination of a macro paper and the combination of a finance paper. It's great to see these two subfields of economics in such nice harmony. So we will have a first paper on an old topic in new clothes with a new perspective on timing consistency and credibility in central bank policy making. And then also a very topical second finance paper on the development of the decline in bank credit relative to other intermediation approaches that is in modern times is progressing so fast. So without much further ado, I would like to ask Pierre Jarrett from the Columbia Business School to take the stage. Pierre is a professor of international business in Columbia and has worked on macroeconomic policy and political economy, as you will see in a second.
Great.
Yeah, floor is yours.
Thank you very much. I'm delighted and honored to be here. I'm presenting work today with Hassan Afrouzi, who's my colleague at Columbia, Marina Halleck at Yale, and Ken Rogoff at Harvard. So let me begin. Oh boy, sorry. All right, here we go. Okay, so the motivation for the paper is we want to think about commitment to inflation targeting, which is a hallmark of modern central banking, and we want to think about that issue, commitment and credibility, in the context of a modern macro model. The previous literature has some limitations. You know, the previous literature goes back to the 80s, Barrow, Gordon, and Rogoff, and some of those limitations are that it's hard to think about credibility, and as that credibility interacts with the deep economic parameters of the environment, that literature doesn't really have transitional dynamics. That literature also doesn't allow us to think about credibility in a quantitative context. And what we're going to offer in this paper is a framework to think about that issue in the benchmark Calvo model that is known to all of you. And that's going to be a dynamic, nonlinear framework. Why does it need to be nonlinear? Well, if you're thinking about long-term inflation, you cannot think about long-term inflation by assuming that long-term inflation is zero, which is what the normal models do. So we're going to move away from that. I do want to mention that while I'll be going through a more complicated model, we have a sister paper in Brookings that does everything very easily and shows that the entire thing reduces to a long-run aggregate supply curve and something that might be offensive to some of you, a long-run aggregate demand curve, and that those two can shift and that you can think about long-run inflation as a sort of an outcome of those two things. So if you're interested in this, you can look at that paper. So here's a preview of the model and the results. We're going to take a off-the-shelf, nonlinear new Keynesian model with Calvo pricing. This has two particular frictions you can think of. First, firms underproduce and underhire because of monopoly power. Second, there's misallocation because of the price dispersion, where low-price varieties end up having too many workers and produce too much relative to the high-price varieties. There's non-neutrality of money in terms of super non-neutrality, in the sense that higher long-run inflation results in higher misallocation and dispersion, but also lower monopoly distortion. So there you can see sort of a long-run trade-off. And in that framework, what we're going to do is to consider the issue of credibility by analyzing the Markov perfect competitive equilibrium, which is a very stark, extreme situation where the central bank optimizes at every date. You know, we think about reality as somewhere in between complete commitment, and we solve that, and this other extreme situation of absolutely zero commitment. So we don't think this is a representation of reality, but it's a benchmark to think about this issue of commitment. what we can show is that in equilibrium, the central bank's going to try to undo monopoly distortions at every single date. And then after you realize that, you can write down the model as a system of 3 equations. It's a forward-looking nonlinear Phillips curve. It's a backward-looking dispersion dynamics equation. And then we show you that you can create this auxiliary variable, this pass-through of real wages to inflation. And there's an equation defining that. And then you can solve the entire thing. So I'm going to show you, and we do this in a deterministic setting, but we think that there's a broader contribution here, which is that the tools and techniques introduced here can be used for thinking about an economy with shocks as well in a tractable way. So 3 main results first, and I'll focus really on the first 2 for the purpose of this presentation. Basically, we can exactly show how changes in the economic environment will drive long-run inflation. And this is important because in the case of commitment, changes in the economic environment have no effect on long-run inflation. Here, because of the lack of commitment, changes in the economic environment, in particular an increase in the labor wedge or a decrease in the elasticity of substitution, result in higher long-run inflation. Part of what we talk about in terms of the applications of this in the Brookings paper is how you can utilize some of these observations to think about the drivers of long-run inflation over the past 4 decades and how you can think about long-run inflation into the future. We argue that the forces that drove it down in the past are likely to reverse and drive it upward into the future. So that's kind of the application, though I'm not going to dwell on this for the purpose of this paper, but just so you can see what the application is. The second result, which was surprising to us, is that in a transition from a low inflation steady state to a high inflation steady state, inflation will overshoot along the path. And that's driven by the interaction of central bank incentives and the changes in the economy. So if we're going to go from a 2% steady state to a 3 or 4% steady state, we're going to have inflation overshoot at the beginning and then gradually decline back down to that 3% steady state. And then we find that what I'll say about the third part, which we're revising that part, is that the cost of lack of commitment can be large, and lack of commitment interacts in a very sensitive way to parameters. And there's some deep economics there that relate to other observations in the literature. Maybe I can talk about them. I'll skip the related literature, but you probably are familiar with some of this related literature. Okay. So the model that we have is a standard Woodford-Galli model, the Calvo model with sticky prices. You have consumers, they consume, they work. So what do? They choose to buy a bunch of varieties. They choose to buy some nominal bonds. They do that with their labor income. They also take the interest and the principal from their nominal bonds. We set it up there's many ways to set it up, as them buying and selling stocks of different companies and getting some dividends from those companies. And what you get are these optimality conditions for the optimal level of varieties, which gives you a consumption bundle, CT. You have the price index. You have intertemporal and intratemporal conditions that pop out. And then you can think about the share price of a firm, which is, the price of a firm is the NPV of its future profits. So that's basic stuff there. And I'm going to just describe the economy quickly before I get into the aggregation and the Markov model. You have firms that can change prices in every period with probability 1 minus theta. They maximize the value of their stock price. What we have here is a payroll tax tau that you can see here that has to be deducted from the firm's costs. After you substitute in, you see that every single flexible price firm is going to choose a price P star in this model. And the one assumption we're going to make, which deviates from many, many models out there, is we're going to assume that the government does not establish a payroll tax to undo monopoly distortions. Okay, so there's not going to be a payroll subsidy to undo all monopoly distortions. That's the main assumption. Why do we have that? Because if we didn't have that, there's no commitment problem. Okay, so this introduces a commitment problem because now the central bank has potentially an interest in undoing monopoly distortions. The central bank at every date sets the nominal interest rate. You also have fiscal policy in the background, though it doesn't really matter, as you'll see. But fiscal authority chooses some lump sum taxes. It chooses nominal bonds. It has a government budget constraint. So here's the order of events. The order matters. if I change the order, I can't solve it as easily anymore, okay? So the order matters. So first, firms set prices. The order is very much like Barrow-Gordon in that you have prices and then you choose policy. So firms that are flexible, they set their prices. If they're flexible, otherwise they choose the sticky prices from yesterday. The central bank then chooses the interest rate. Then the households optimize. And then the fiscal authority chooses lump sum taxes and debt, okay? So that's the order of events. There's a whole bunch of equilibria that you can have in this setting. We're gonna focus on the issue of credibility and commitment by considering the Markov equilibrium, okay? So what's a Markov equilibrium? Every single decision or strategy by every player, the firms, the households, the government, the central bank, are a function only of the minimal payoff relevant variables. Okay? Now, because of Ricardian equivalence, that means the level of nominal debt doesn't really matter. So without any loss of generality, you can just set that to zero because you know, the set of continuation Markov equilibria at every single date is not dependent on that level, so I don't have to worry about it. So then you can think about a game here with the following strategies. You know, flexible price firms enter the period, they see price distribution omega t minus 1. That's all of the prices chosen at date t minus 1. And as a function of those, they set their flex price p star, okay? That determines the distribution of prices that we will be entering the period with tomorrow, omega t. I want to emphasize that because it is actually important because it helps us solve the whole thing, which is that the state variable tomorrow is essentially chosen at the beginning of the period today when the flex price firms determine their price, okay? And the central bank takes that as given. Then the central bank chooses the nominal interest rate as a function of the distribution of prices omega t, and then households make their decisions as a function of omega t, the distribution of prices and the interest rate. And a Markov equilibrium is a collection of all of these mappings, okay? All right, so that's the setup. Now, it's a Markov perfect competitive equilibrium. So the first thing I'm gonna do is I'm gonna give you a bunch of, I'm gonna do a primal approach to show you what needs to be true for this to be competitive, okay? So a bunch of aggregation, I'll show you it's gonna reduce down to 3 equations. Then after I do that, there's gonna be a bunch of equilibria that'll be possible. I'll briefly show you the commitment one, and then I'll say, let's focus on the Markov, okay? So that's where I'm going. All right, so let's do some aggregation. You can do market clearing of the product market and labor market, and basically what you get is that you can define a variable dt, which is dispersion. It's basically dispersion of prices. It's got to be bigger than 1. If it's equal to 1, it means all the prices are the same. If it's bigger, it means some prices are high, some prices are low. It's like a TFP variable because the total amount of production is equal to the amount of labor divided by dispersion. So the higher dispersion, the worse, the lower the production holding labor fixed. And there's just a couple of things that'll pop out later that are useful to think about. One is the labor share, we call it mu t, which is actually the ratio of the marginal rate of substitution, marginal product of labor. And I'll show you that kind of that's gonna play an important role later, and then the real wage, okay? All right, so let me show you how this whole thing reduces down to a simple system. First, dispersion is a backward-looking equation. Dispersion of prices today is a function of the inflation today and the dispersion from yesterday. So the higher the dispersion yesterday, the higher the dispersion today. And also it turns out, as you might imagine, that the higher the inflation today, the higher is the dispersion today, okay? So more inflation leads to more dispersion, all right. Then you've got a nonlinear Phillips curve, which pops out, and we have a way of writing that recursively, which is as follows. It sort of looks like the one you're all familiar with, it just has a little twist in there, which is that the inflation, you have inflation today over here, you have inflation tomorrow over here, then you've got the real wage, okay, sorry to be pointing, and then the key new thing is this delta T, which is a pass-through from future inflation into the pass-through from real wages to current inflation. That's the right way to think about it. And that's a function of the sort of all future inflation rates. So it's got a nice recursive structure, which helps to solve this whole thing. All right, so, and like in standard Phillips curve, if I hold that pass-through fixed, higher current wages leads to higher inflation, higher future inflation leads to higher current inflation holding things fixed. So just to give you a flavor of how the model works and why there is money is not super neutral, you can think about hypothetical steady states in this world and say, well, what do these hypothetical steady states look like? Turns out they can only have inflation within a certain bound. We can talk about that later if you're interested. But those hypothetical steady states have the feature that if you're in a steady state with higher inflation, that is necessarily a steady state with higher price dispersion. That's sort of intuitive. There's going to be more sticky price firms left behind, okay? But you're also in a steady state with a higher labor share or lower markups. Why is that? Well, it's because you've got more overhiring by sticky price firms, and that greater overhiring by sticky price firms is overwhelming the other force, which is that flex price firms are anticipating the inflation by increasing their prices a lot. So you got this race going on between the sticky price firms and the flex price firms that's resulting in higher labor share, lower markups, the higher the inflation rate. So it does mean that there's a steady state trade-off between dispersion, which you can think about as a distribution of distortion, and the aggregate monopoly distortion. So there's a trade-off between aggregate distortion and the distribution of distortions that exists in such a setup. That's observation number one. Observation number two is that nothing pins down inflation dynamics here. I can easily just have an immediate transition from a steady state with 2% inflation to a steady state with 3% inflation or 4% inflation. Nothing prevents that. You can have those dynamics in such a setup. All right, so how are we going to pin down the equilibrium policy? Let me just give you a benchmark, and I'm not going to dwell on this one, but there's some interesting observations here. It's been studied before. Here's a benchmark. Let me think about a central bank with commitment. Let me observe that I can write the objective function as a function of dispersion, D, and labor share mu. That's some algebra. Turns out you can write this thing recursively, but that's not important. We solved the sequence problem also. But the key thing to note is that if you have commitment, so if a central bank at date zero were to solve this problem, okay, and remember, there is a monopoly distortion, so you kind of have an incentive to undo it. But the key thing is that you have zero, you never undo it in the long run. You commit to not undoing it in the long run. You commit to a flex price economy in the long run. That's a result. It is the only steady state under commitment. What does that mean? That in the long run, you have zero inflation under commitment. Moreover, the economic environment does not affect long-run inflation. So if you want to give me a theory of how the economic environment affects long-run inflation, you have to start talking to me about central bank incentives, which is what we are going to be doing next, okay? So let's talk about central bank incentives. I'm going to do it in the Markov model. What's the payoff relevant variable here? Payoff relevant variable is the dispersion of prices. It's a sufficient statistic for the entire distribution of prices because it subsumes the entire distribution of prices. The central bank takes the dispersion of prices today, and guess what? It also takes the dispersion of prices tomorrow as given. Why? Because the firms at date T set their prices prior to the central bank choosing the interest rate. So from the central bank's perspective, it's behaving in a very myopic way where it just takes the price, the entire sequence of prices into the future as given. And those prices, of course, internalize central bank incentives. And so as a consequence, the central bank ends up stimulating the economy in order to undo monopoly distortions. What's interesting, and this is relative to Barrow-Gordon, is that all firms realize that the central bank is doing this, and it's not just the firms at date T that realize that this is going on. It's all the firms prior to the current moment realize that this is what the central bank is doing. So that's what happens. No commitment, the labor share or the markup, it undoes all of the markups. What that means is you can write down that system of equations I had before by substituting in the labor share, okay? So this is the same exact system as before. And then this is only to facilitate the dynamics of the analysis, not the steady state analysis. I'm going to take time to zero. We're going to write this all out in continuous time, and so now you've got three equations. You have the dispersion, that backward-looking dispersion equation, the nonlinear Phillips curve, and the wage pass-through equations. I don't know what those words mean at the bottom of the slide. Those are Hassan's words, Hartan, I don't know what that means. But anyway, it's a complicated thing. And so the main thing that you get, I'll now go through my results, okay? So the first result is there's a unique steady state in the Markov game, okay? That steady state defines a level of inflation and a level of dispersion. And interestingly, you can make claims about how different parameters of the economy will impact steady state inflation. For example, an increase in the labor wedge ends up leading you to a world with higher dispersion and higher inflation. A decrease in the elasticity of substitution will do the same. Okay, we sort of think about this as, you know, which is what we write about in our other paper, loosely as like a deglobalization shock of some sort. Okay, that can increase monopoly power, and that's going to, or flex price monopoly power, which is going to lead you to more inflation. So let me give you a little bit of intuition for this. Take as a benchmark an economy where the payroll taxes are chosen perfectly to offset all monopoly distortions. Okay. This is an economy where the best thing to do is also the one that would coincide with no commitment, which is zero inflation. So now let's just say that we increase distortions by epsilon. Well, if we had perfect inflation targeting, then the economy would maintain zero inflation and the economy would immediately jump to lower labor share, higher markup economy. That's what would happen, okay, if you had perfect commitment. Now, we don't have perfect commitment. Okay, the central bank, this is not incentive compatible for the central bank. If firms were naive, the central bank would say, terrific, I'm going to stimulate. Well, the firms are not naive. Flex price firms anticipate that the central bank is going to respond to this with greater stimulus, so then they're going to raise their prices. The flex price firms today will do it. The flex price firms tomorrow will keep doing it. So you're going to get these sequential price increases that are going to gradually increase dispersion along the way, okay? As they increase dispersion along the way, the incentives for the central bank to keep stimulating are going to dissipate, and eventually you're going to land on a higher inflation steady state. Okay, that's result number one. Result number two is that, you don't have to read this, but the result number two is that a transition to the new steady state involves overshooting of inflation. Okay? So as we go from a low inflation steady state to a high inflation steady state, inflation overshoots. We prove this with a three-dimensional nonlinear system, so it's complicated. But but we can kind of do this in a phase diagram, and we can do it exactly in a special case, which I can show you with a phase diagram, where you can write the d dot locus, the pi dot locus. You can write you have the stable arm there, and what you can show is that if you shift to, let's say you increase monopoly power by shifting the Phillips curve, the nonlinear Phillips curve, which is one of the loci here, the pi dot locus, you end up having inflation overshoot and it converges back down. You know what I'm gonna do? I'm gonna give you an intuition for this versus going through the math. The intuition for this is as follows, okay? When you have a shock, okay, this is a permanent MIT shock, so you have a permanent change in the economy that increases monopoly power. Everyone recognizes that the central bank is going to stimulate, and so the flex price firms will increase their prices by a lot. So you're going to have a lot of inflation at first. As we go along, dispersion is going to keep rising. Okay, so as dispersion rises, real wages are going to fall. And as real wages fall, the incentive for future firm price increases will diminish. So that's why the largest price increases will happen at the very beginning of the transition, but then they're going to gradually go down later into the transition. That's why you're going to overshoot in inflation on your way to a new steady state. What I'll do maybe I should just say that part of what we do in the Brookings paper is do a log linear approximation around a special case Maybe I should advertise this. If you look at the special case as sigma, the elasticity of substitution goes to 1. We solve this exactly, which is pretty cool. You can show the exact system of equations, solve it by hand. And anyway, so that's just a little thing for you, just for fun. So then the last thing I'm going to show you is just to tell you a story. Forget about the numbers, because this is not a quantitative paper. This is more to illustrate how the responses look, to inspect the mechanism. So this is like an unanticipated increase in the labor wedge. Same thing happens with an unanticipated decrease in the elasticity of substitution. So naturally, we're going to go to a higher inflation steady state. What happens along the way? Well, clearly in the top left, you see that price dispersion is going to gradually increase. Output's going to gradually decrease. So labor here is fixed. Nothing's happening to labor, but output is decreasing because price dispersion is going down. Price inflation, you see the overshooting there. Inflation goes up at the beginning and then gradually goes back down. The nominal rate jumps up and then gradually lands at a higher level. So you kind of get a Fisherian effect, a long-run Fisherian effect that shows up here because you're moving to a higher inflation, higher nominal interest rate steady state. The real rate declines at the very beginning because the central bank is sort of partly accommodating the shock. And then interestingly, you have wage inflation jump and then rise up, but you have a real wage decrease, long-run real wage decrease. So the total net increase in wages is actually behind the total net increase in prices. And then we kind of show that the value of commitment can be large. The last thing I will say is that there is something interesting that emerges here is that the sensitivity of long-run inflation to even tiny little changes in the environment is extraordinarily high, and that is related to the fact that firms are extremely forward-looking in the standard baseline calibration of the Calvo model. That's related to other observations in the literature. In conclusion, what do we do here? We basically look at how to analyze lack of commitment in the nonlinear New Keynesian model. That gives you long-run implications, long-run transition dynamics. I didn't spend too much on this, but in the sister paper we wrote, I'm sorry, I'm in negative territory here for minutes. In the sister paper we wrote, we spent some time saying that inflation globally declined over the past 30 years, not just because of the beauty of central bank independence, though of course we all believe that that's very important, but because the job of central bankers was made a lot easier by various different things like globalization, Washington consensus, and fiscal prudence, at least in emerging markets. And we believe that moving forward, the job of central bankers will become incrementally harder because of the reversal of some of these things. So that's what we use the framework to say, and I'll just leave it at that. Thank you very much.
So thank you very much, Pierre. We really need somebody to dissect this difficult model from us, and who's better prepared to dissect these set of equations than Albert Marseille from Barcelona, who is the research chair for macroeconomic risk at the Barcelona School of Economics. Floor's yours.
Hi. So thanks for having me in the conference. I had spent quite a lot of time in the ECB like 20 years ago, but I haven't been lately, so it's very nice to be back and see many people I have met over the years. I'm not going to dissect the paper. Okay, so the first thing I was going to say is I've never written a paper on sticky prices, so I cannot do that. So I'm not an expert on that. I'm going to try to use the chance that I was invited, and I took it, so to relate what Pierre and co-authors have done to a few issues that I think are important and that matter, and how I see the usefulness of this paper. So first of all, it's a great paper. I'm very sympathetic to the idea that we should address nonlinearities and transitions to steady state. It's okay to, I also do linear approximations if they simplify the analysis, but I think the profession is kind of forgetting that these are approximations, okay? And they could be quite bad. And we have more and more papers pointing this out, and I think this is a very good contribution in that sense, because it's furthering that that view. Also, the profession focuses on long-run, steady-state results, especially for policy and for many things. And I think the profession also forgot that the steady state is something that could take many years, and it's perhaps irrelevant in order to decide what we should be doing now. So, in that sense, I'm totally sympathetic to this, and I think just because they do this and they do it so carefully and they are so they don't take any shortcuts, I think that's a great paper. I also like it because it talks about an issue we are working on, which is trying to reconsider issues of timing consistency. They point out, because they solve the two models exactly, they can point out that something we've seen in other papers, but they show us now that the costs of no commitment are very large, or can be very large in this model. Okay, so the full commitment welfare is much larger than the no commitment. So I would like to take this chance to talk about the last thing, about issues of timing consistency, and about transitions, and about another thing that I would like to see, perhaps in the next paper. I'm not a fan of huge papers, so maybe the next paper would be interesting to see how this works on a heterogeneous agent model. And I think there's here a lot to do and very little that has been done. There's a lot to do on optimal policy with heterogeneous agents. So I'm going to talk a little bit about some work we're doing and relate it to what they have done. So let me talk about this paper, which just published. It's basically a Chambly model with heterogeneous agents. Okay, so there's capital taxes, labor taxes, government can save and issue bonds, and prices are flexible. The only unimaginative thing we added is heterogeneous agents. There's one agent that has a lot of capital income and another that has much less capital income. There are two. We calibrated to the economy. We know that there's this long-run zero optimal capital taxes in the long run, which Straub and Werning have kind of revived, and they show cases where it doesn't work, but still in most cases it works, and in our model it works, that capital taxes should be zero in the long run. And basically what we have, let me skip this. What we have then is I'm going to use the pointer so the people here don't see the pointer, but what we have is the following. Let's say 0 is normalizing the welfare of the two agents. Okay, so 0 is normalizing to a benchmark, which is the current capital labor taxes. Okay, this is a Pareto optimal frontier, which is something that we teach undergraduates, but we don't use very much in macro. Okay, and I think we should go back to these frontiers just as we teach them in intermediate micro. This is what happens in the model I just showed you. What happens is, if you do something like what you would think is the Chambly result, I'm going to take more time. You're kind of way over here. You really screw the workers. Okay? If you do what's optimal for a homogeneous agent model, you screw the workers a lot. It's kind of obvious, unless you've been doing Chambly models all your life, because you lower capital taxes too quickly, workers lose. If you constrain yourself to Pareto improving solutions, that's the solid blue line, okay? Pareto improvement above 0 for both, then you could do that. But what you have to do is to have a much longer transition. Yes, you have 0 capital taxes in the long run. We want a model that has that to point out that there still is a redistributive issue, and that in order to make the workers accept a capital tax cut, you have to tax capital for a much longer time. Okay, so as we move this way to the right, as we move to the right of the Pareto optimal frontier, we need to tax longer and longer and longer capital, and then we reach second best optimum, far from the lump sum tax redistributive, which is the black line. Is that clear? So, and by the way, the psi is the weight of the second agent, of one of the agents, it doesn't matter. So psi 1 is what almost all the papers in macro doing optimal policy do, which is we give the same weight to everybody. But that's silly. We tell undergraduates not to do that, not to do intertemporal utility comparisons. What we should be doing is look at the Pareto optimal frontier. The welfare weights are just a mathematical trick to get over the frontier. And well, if we do psi equals 1, we don't get a Pareto improvement. Okay, with this calibration, we calibrate everything. So where this speaks to the current paper is, well, then this is the whole optimal taxes. The different lines are different points on the Pareto improving region. And the time is years, so it takes 20 years of very high capital taxes and 20 years of low labor taxes to get to the optimum. Okay, so this is another example how the transition matters. If we just look at long-run results, they don't tell us what we should be doing for the next 20 years, according to this model, which is the opposite. Okay. So this is another example of how looking at long-run results may be very misleading, and why I like this paper. But there is another issue that relates, that we don't have a paper, we're working on this, but it's the following issue. Let's look at time inconsistency in this model I talked about, or in many in many other macro models, okay? If I have time, I'll talk quickly about a macro monetary model where the same issue arises. Why did we, for about 50 years, think of of full commitment policies as not sustainable, okay? I mean, I don't remember what Ed and Finn wrote, actually, because I read their paper so long ago, but I think that what the profession thinks is there's kind of two issues that are related. One is, if the government reoptimizes a full commitment policy in the future, it will want to change it. This is kind of what almost literally, the first bullet point is almost literally what Sargent and Ljungqvist wrote, and it's one way to write. But kind of following that is that everybody will agree to a change in policy. Okay, so how can you promise a policy that everybody will say this is not a good idea? And it's kind of what is the same as what in game theory they call not being renegotiation proof. There's a long tradition in game theory where, you know, if all the parties that wrote a contract agree to change it, you will not write it to begin with. Now, in the model that I wrote, what would happen if you reconsider, okay? If you, in the Chambly heterogeneous agent model, what happens if in period 5, Q is the period where you would reconsider. What would happen if you reconsider and you say, well, I promised to do this, but what happens is that this is the Pareto optimal frontier in period 5, okay? And this is the value of the continuation. The continuation is Pareto optimal, okay? It is still, but wait a minute, I know it's time inconsistent, right? And yes, it is time inconsistent if you keep a weight of one, okay? If you start with a weight of 1, and in period 5, you consider, do I want to re-optimize with a weight of 1? Then it's true, that would be the point. That's what you would do. You would have a different welfare and a different policy. But it's not true that everybody would agree to it. And not only that, you would not be able to get approval for any policy that needs 50.5% of the votes, okay? This is true in our model. I think it's true in many other models. It's not true in every model of full commitment, but it is something that I think is, you know, I think it's important when we talk about commitment of monetary policy, okay? And we think of it, no, we need to be really tough and really, you know, hard-nosed and so, but it doesn't matter how hard-nosed you are, you know, at some point the Bank of Argentina was hard-nosed and they were just brought down by the government, you know. So the Bank of Argentina wanted to not use the currency reserves and the government said we would like to spend them and they did. They just, so in order to think about commitment, what's sustainable, what's not, I think we need to bring back heterogeneity in models of optimal policy and to think about how we resolve this conflict. You know, what happens is that there's going to be a social conflict, which point on the frontier we might want to re-optimize to. And we need to bring in our models that, what it is that we would do if we would reconsider. So very quickly, I don't have the time to but think of a monetary model. This is the ECB, so I thought just before coming here, I would write a monetary model. Same issue would arise in a kind of older, I mean, before Jordi, money model, where you have money in the utility function, flexible prices, nominal bonds, okay? And there are taxes, so there's labor taxes. We know that in this model, the budget constraint is like this. The discounted budget constraint, the government can complete the markets actually. The budget constraint is such that the government wants to inflate as much as possible in the first period, right? And depreciate the value of bonds, okay? So since I have 30 seconds, let me, well, that's and a homogeneous agent would be very happy with that, with a government that promises to have a high inflation in the first period and promises to never do it again. Now, think what happens if you have two agents. One has a lot of bonds and the other doesn't. It's not true that they will agree to do it again. So there is no time inconsistency again, okay? So that's 0. I was really good actually at this. So that's all. Great paper and made me think about a lot of issues.
Albert really had his last breath before the thing turned red, so that was quite an achievement. While the audience gathers its thoughts for any questions you may have, maybe if you have anything to add to,
sure.
I was about to say to dissect Albert's new paper he's working on, but
sure,
he will probably not do that.
Well, maybe I'll just say thank you. I appreciate very much the comments, very thought-provoking. I thought just in terms of, there is an analogy, of course, to the capital tax result in the sense that the optimal capital tax is 0 in the long run. Here, the optimal inflation rate is 0 in the long run, but then there's an issue about the ability to commit to that. One key difference is that relative to capital taxes is that you've got this, you're carrying, everything is happening with this dispersion thing that's moving around over time, the analog to that, and the capital tax result economy doesn't quite exist. There is buried in here is a distributional conflict that we don't take care of, that we don't really explicitly look at because it's a unitary agent. But as you suggested, there's capitalists or there's firm owners and workers, and one thing that's going on in the model is that a byproduct of low inflation, which is what you'd like to commit to, is higher markups. And so what happens in this economy is a rapid decline in inflation is going to result in higher equilibrium markups. So the question is, who's going to dislike that? Who's going to like that if you had a heterogeneous agent economy? I will mention just a little plug for Andreas Schaub, who's an extremely prolific young assistant professor now at Berkeley, who has some work on no commitment in a monetary model, but he's got Rotenberg pricing, and so he's sort of thought about some of these distributional issues as well. So that's what I'll say.
Okay, yeah. Very good. I had already 3 questions. We start with Jordi Gali. Barcelona is counting a second time. Otherwise, you please state your name and affiliation before you speak, but I have already done that.
Okay, well, thank you. Very nice paper. I have 2 comments. First, well, as you know, one can do your analysis using the linearized model around the zero inflation steady state under the assumption that, the resulting new steady state will not be too far from zero. And one can derive an analytical expression for the steady state inflation under the equilibrium, under optimal policy without commitment. So I think it would be useful to get a sense of the extent to which that approximation is good or not. Okay, so to play with a couple of parameters, and see to what extent the implied steady-state inflations are very different or not. Of course, the linearized model doesn't have the transitional dynamics.
Right.
Okay, so that's clearly an interesting insight from using the nonlinear model. And the comment, my second comment has to do with the interpretation you gave at the end of recent developments and inflation through the lens of your model. I kind of disagree with that in the sense that, well, of course, you want to give up, like, you have your model to provide a positive theory of inflation, but I think one may reinterpret what has happened in a different way. We have plenty of evidence by Yan and co-authors that this inefficiency wedge may have increased, particularly because markups have increased. So if anything, that would have led to, under discretion, to higher inflation. We haven't seen that. If anything, we have seen the opposite. So but at the same time, we have seen more and more central banks around the world to adopt inflation targeting policies with explicit inflation targets. So one may reinterpret this as an attempt by central banks to somewhat commit themselves, of course, they don't do the optimal policy with commitment, but to commit themselves to a steady state inflation, given that the temptation to, to inflate has been increasing because of the increasing wedges. So that's just a reinterpretation of.
So can I add?
Yeah, let's go, but we need to be a bit shorter because I saw many questions.
I won't filibuster.
Yeah.
We did the linearized comparison. The linearized model would give you way too much impact of commitment. So the fact that you do the nonlinear thing, you don't have as much of a reaction. That's because of the dispersion in there. That sort of limits the commitment problem. So that's kind of the short answer. The other one is, I think that you can have multiple different forces going on that affect central banking. And so you could have some forces that cause markups to go up, but then you have other forces that cause them, it's about the flex price markup. It's not about the equilibrium markup. So that's what we do suggest in the paper is that if central banks become more hawkish, which we definitely agree is part of the explanation for why inflation went down, you will get higher equilibrium markups. So that is consistent with what we see. It's just a different reason why you get higher equilibrium markups.
Okay, there was Dimitri, and then there's Stein, I believe. Yeah.
Hi, Dmitry Sergeyev, Bocconi University. Thanks, Pierre, great presentation. So I have 2 questions. First, so you think of commitment problem as arising from presence of this markup distortion. Another distortion that people kind of talk about a lot when think about inflation target is the presence of the ZOB and the fact that central banks hit ZOB from time to time. So I'm sure you have thought about this problem. So I wonder whether you have something to say about that. And second, you solve a game between the central bank and the rest of the agents of the economy. Mirroring a little bit what Georgie said, central banks try to commit. And one of the approaches that people used in this old literature that you cited is optimal contract approach to, or optimal contract design approach to inflation targeting. So if you consider that, what would be the outcome in your environment in that case?
Okay.
Go ahead.
The ZLB is really, the commitment there has to do with in a world where you'll eventually exit it and you have to promise to do certain things later, right? So we have nothing to say about that here because don't have shocks. The one thing I will say without doing the exact model is I think about the ZLB as a commitment to be more hawkish. So that's kind of how I think about it. So the ZLB, if anything, is a force for preventing the central bank from caving into the temptation to stimulate in an average sense. So that's how I would think about it, and I can write little models to sort of show that. We've done that. I've worked on the optimal contract design approach. I have another paper with Marina Halleck on instruments versus targets, sort of thinking about that issue. And actually, I'll plug Andreas Schab has another nice paper, which I believe is forthcoming in AER, that's also thinking about this optimal contract approach in a dynamic New Keynesian model. I've definitely thought about that. We didn't do it here specifically, but it would be interesting to think about.
Okay, I think next was Stein.
Yeah, thanks very much, Stein Claessens. My question was more translating that to the policy environment in terms of the mandate and the communication central banks does. So does your paper, because it gets difficult, right, to think of this commitment and how to translate that, particularly if you have heterogeneous agents, in terms of the dual mandate, is that a proxy you can think of achieving what you have in mind? And then second related question is on the recent reviews of monetary policy frameworks, which have more of an asymmetry component to it in the US and even in here at the ECB, thinking more the ZLB, but beyond that also think on the distributional impact.
To answer this question, I'm going to answer in a way that gives you my personal opinion. I can't claim to represent what my three other co-authors believe. I think the one thing you learn from this is that there is no such thing as the natural rate of output. The natural rate of output is the one that is consistent with the inflation target. Okay, so that's what happens in this framework. You give me an inflation target, you give me a natural rate of output. So if I wanted to give you my 2 cents about what I think should happen in the strategic review, is it should be very clear that this definition of what the maximal employment is. It is not this thing that drops from the sky. It is this object that is consistent with the inflation target. So that's like a very different way of thinking about maximal output. And I think that's consistent with the framework.
I'm afraid you're going to see a central banker with limited commitment because even though I'm red, I want to take a few more questions because I like this discussion. So could those who still have a question quickly show? So, okay, I have Guido and I have Anton was, I believe, first. So I still take you 2 and then we move to the other paper. So please try to be concise given my commitment problem.
Anton Nakov, ECB. Thanks a lot for a great presentation. I have 2 suggestions for extensions or questions. How would your results be affected? One is if you had large idiosyncratic shocks in the Calvo framework, not necessarily, keeping the Calvo fairy, I think then price dispersion would be moved mostly by these idiosyncratic shocks, and the dynamics can change quite a bit. And the second is, of course, if you had state-dependent pricing, that it could be inflation decreases price dispersion. So again, things could change there in terms of the final result you obtain for the optimal inflation rate. Thank you.
Go ahead and
maybe I'll take another one and I'll
okay,
we'll do the 2 at once.
Guido Scari, University of Pavia and the MBA. So no, I would have many points, but I have to cut. So one would be, there's a Yoon old paper in the AR which does something similar. So I just wanted to know what's it's a great paper. I think it's a very important topic. The other thing is, I think if you have indexation, basically you have no price dispersion, or it's very little, and all the problem washes away. The price setting also matters a lot. If you have Rothenberg, for example, results quantitatively at least will be very different. There's a literature on the cost of trend inflation that I think I wrote a few papers about. And that explained the point by Jordi. Actually, the log linear model around zero inflation is a very bad model. It's a very bad log linearizing approximation for the nonlinear Calvo model as it is. And that's why you get that the results are very sensitive to very change of parameters, because that's in that very point that the model nonlinear is exactly. So you may want to look at this literature too.
Absolutely. Let's talk some more after that. I will just say that as you approach flex pricing, lack of commitment becomes even more of a problem, because it's a race between the firms and the government, and so it becomes a much worse situation. The previous question about idiosyncratic, we haven't solved it, but I think the way you want to think about dispersion here is dispersion relative to the flex price dispersion, right? So it's misallocation relative to the misallocation that is efficient misallocation. That's kind of the relevant quantity that we are looking at.
I think then we have it. Thank you very much. Maybe another round of applause for the two. So, we make a huge leap to the data and to the secular decline of bank balance sheets. So Amit Zero is a professor of finance at the business school in Stanford, and 25 minutes is your time.
Thanks to the organizers for giving me an opportunity to present this paper. This is joint work with Greg Buchak, my colleague at Stanford, Gregor Matos at Northwestern, and Tomek Piskorski in Columbia. So the motivation for the paper is pretty straightforward. Banks are considered pretty central for lending in many policy debates. Most recently, you would have all seen in the Basel III discussions, this was the pretext of the debate there, that banks are central, and any shocks, adverse shocks to bank will lead to a major change in lending. Why is this the view? Because the bank balance sheet view sort of says that banks are basically important for channeling resources from savers through deposits to the users or the borrowers. And implicitly, if there are bad effects of regulation on lending, if you don't have many substitutes available. So that's something that is implicit in the bank balance sheet view. And in our prior work, we have sort of tried to look at this in the context of mortgage market and other consumer markets, and try to understand whether this assumption is reasonable, what happens, how special are bank intermediaries. And in this paper, what we do is take a more broader view beyond just the mortgage market and ask the same question. Essentially, what we are after is that do shocks to bank balance sheet lending affect aggregate lending? And as you're answering that, you want to sort of think about, are there substitutes in non-bank sector? If you take a very extreme view, you can think about full decoupling between banks and non-banks, and that would say that shocks to bank sector doesn't really affect if the substitutes are pretty good. So that's one extreme view. You also want to understand probably that are banks potentially complements to non-bank lending. So the other extreme view here would be that if we are bank-centric, and for every dollar of non-bank lending, if banks are important, you want to sort of, shocks to the bank balance sheet are still going to be pretty important. So that's a quantitative question, and we want to understand this in the context of banks, like I said, in the broader context. So that's what this paper tries to do, tries to understand this in the US context in the last 60 years. There are two parts to the paper. I'll touch briefly on both parts, but you'll have to read the paper because I have 22 minutes. So the first part is just documenting facts, which are going to be quite critical to answering this question. And then the second part is going to take those facts and put it in a quantitative model. So let me just briefly tell you what we do on these parts so that you have a sense of what's inside the paper. So when it comes to facts, the main sort of fact that we are going to be sort of focused on is that there is a big decline in bank balance sheet lending in the US since 1960s. So the first fact I'm going to show you on the lending side, and if you consider bank balance sheet lending as informationally sensitive, at least relative to non-banks or originate to distribute, what we show is that there is a pretty dramatic change here. And this is across all major segments, not just mortgages or consumer credit. It's pretty much everywhere. And you'll see what I mean in a second. Similarly, on the saver side, what you see is that there is a decline in deposit as a share of savings from the savings sector. And both of these things together are going to inform us about potential substitution of banks to non-banks. Then we are going to sort of spend some time talking about the third fact, which is the bank balance sheet itself has seen a pretty dramatic shift from loans to securities. And that sort of tells you a little bit about what are the interlinkages between bank balance sheet and non-banks. And the idea being that there is more of an interconnection now than before. In the paper, we sort of spend some time talking also about, besides aggregate trends, focusing on some micro evidence, which kind of tries to pinpoint these things a little bit. So, for example, securitization technology and what it does. Similarly, on saver preferences, when there's an increase in shadow money, what does that mean in terms of bank balance sheet lending? And similarly, when you look at banks itself, the effect of regulation and subsidies on banks' balance sheet. I'm not going to spend too much time on these things, but they are in the paper. What I'm going to sort of spend some time on is when we look at these facts and we try to interpret them, of course, you can think about banks and non-bank linkages between full decoupling that I told you before and a bank-centric view, and ultimately it's a quantitative question where we are. The real world is going to be somewhere in the middle. So we are going to develop in the second part a quantitative model of intermediation. What does it have? It has pretty standard pieces. One is there's going to be a saving sector, there is going to be a borrowing sector, and there is going to be financial intermediaries channeling the resources from one sector to the other. There's going to be banks and non-banks in this intermediation sector. As I'll illustrate in some detail, banks are going to be issuing deposits to make informationally sensitive loans, and they're going to manage their balance sheet through securities and so on. Non-banks are going to issue debt securities and make informationally insensitive loans. The interlinkages are going to be important because we'll allow the data to tell us how important these are. So in the interlinkages, banks can act both as a substitute and as a complement. They purchase securities and also do some joint productions. For example, when you do CLOs, you can imagine banks and non-banks operating together. Once we have this quantitative model done, the idea is to sort of look at these macro trends that I spoke to you about before and decompose those into borrower-driven shifts. So these are going to be shifts in demand curve for bank loans versus non-bank loans. Saver-driven shifts, which is going to be demand curve shifts for deposits versus other saving technologies. And bank-driven costs or subsidies, depending on regulation and other shifts that have happened. And in case I don't finish, the model allows us to do two kinds of exercises. One is when I look at the main aggregate trends, it allows us to decompose these things. And we find that if you look at borrower demand shifts, they explain quite well aggregate lending quantities and composition of bank versus non-bank. When you look at saver demand shifts, they explain very well the bank balance sheet size. And if you look at the regulatory changes which affect the bank costs themselves, they affect the bank balance sheet composition. That's one piece of the model that the model does. And the second piece is we can do counterfactuals, like if you imposed high capital requirements, remember the debate on Basel III, what do you see? Well, we find that there's a large impact on composition on the bank balance sheet, but small effect in aggregate lending. And just as a preview, why is that the case? Because non-bank lending turns out to be a good substitute in the data. And when banks are adjusting, they actually adjust on the margin of securities by selling securities before they actually contract lending. So in some sense, you can think about this as MM in aggregate due to substitutes available for bank balance sheet lending. Okay, so let me get into some more details. What's the data? At the aggregate level, we are going to look at flow of funds in the data, and one of the series is going to be total lending. That's outstanding debt of households and non-financial businesses. This series from 60s till now goes from about $1 trillion to 40 trillion. We'll be interested in two segments. One segment is going to be the bank balance sheet lending segment, which is called informationally sensitive in the banking literature. Why? Because banks screen and monitor. So there's a qualitative assumption that banks are special. Quantitatively, the data will tell us how much. Over time, the most current in 2023, out of 40 trillion of total lending, this is about a third. The rest is debt securities. So this is total lending minus whatever is informationally sensitive. And there are many pieces here. There is government-backed debt securities. There is private debt securities. If you look at debt securities, that's 2/3 of 38 trillion in 2023. Private debt securities account for about 60%, government affiliated about 40%. So when you think about GSCs, they are in here, but they are not all of it. So just to fix ideas, as I show you the data and the facts, it's useful to sort of talk about the map of the flow of funds. So here is how you should think about what I'm going to show you and how the economy fits together. There are going to be borrowers who are going to receive loans from banks and non-banks. Banks are going to make these sensitive loans and are also going to have securities and other assets on the asset side. They're going to fund themselves through deposits and equity, which is going to be on the financed by savers. There is also going to be a non-bank originate to distribute sector, which is going to finance the insensitive loans. They are going to be funded by loans from banks as well as securities, which are owned both by banks and the saving sector. So as I show you facts, they'll fit somewhere in this map, and I'll tell you a little bit briefly where they fit in. So here is the first fact that I talked about. So bank balance sheet lending as a share of total lending has fallen from 55% in mid-60s, early 70s, to about 33%. And over this time period, if you're wondering, there were a bunch of changes that happened, including securitization and development of technology related to credit scoring and so on, which kind of you can think about as making non-bank sector a little bit more competitive relative to banking sector. These patterns are not just in mortgages. For example, on the left, they are also in non-mortgage sector. On the right-hand side, you can decompose it in different ways. Business and consumer credit, you see these patterns everywhere. The numbers might not go from 55 to 30%, but there is a secular decline in bank balance sheet lending everywhere. The second fact that I sort of mentioned before is on the saver side. So what is this? Deposits as a fraction of financial wealth of the domestic non-financial sector goes down from 20% to 13%. Remember that deposits as a share of GDP goes up during this time period, so that tells you financial wealth as a fraction of GDP is growing even faster. So what happened here? A bunch of other changes as well, like money market fund reforms, pension fund reforms, and so on. The third fact relates to the composition of the bank balance sheet, and here I sort of mentioned before that the loan share of bank assets falls from 70% to 55%. And what happened here, which might have led this, many things potentially, including regulation, most recently the Dodd-Frank. And concurrently, as the loan share of bank assets has fallen, it's not like banks are not doing anything. They are actually investing more in securities. Now remember, securities fund non-bank sector, so banks are implicitly going to be interlinked with non-bank sector. They also directly lend to non-bank sector on the right-hand side, and you can see that that proportion has remained stable and kind of gone up over time. So back to the map that I showed you before, you can see that these facts actually tie to different pieces in the intermediation map that I showed you and the flow of funds. So for example, when I sort of talked about bank balance sheet lending share, that's really talking about the liabilities of the borrowing sector. When I talked about the deposit share, that's talking about the asset side of the saver sector. When I talked about the bank lending loan share falling, that's really about the asset side of the intermediation sector, the banks. And then when I talked about the bank share of non-bank liabilities, that's really talking about the liabilities of the non-bank sector. So these are the facts, and like I told you already, that we have a bunch of micro evidence in the paper which kind of gets at trying to nail these mechanisms down, but I'm not going to talk much about it. If you're interested, we look at, for example, shocks to securitization and see what happens to the amount of loans banks make, what happens to the security exposure they have. Similarly, as shadow bank money share increases, we ask how much of that explains financing of private credit. And as regulation has changed over this time series, we asked what role does it play in terms of bank loan share. But I'm going to skip that. So let me talk a little bit about the quantitative model. Remember, the quantitative model is trying to do a couple of things. Very briefly, I've already mentioned there are 3 sectors in here. And what is important to note here is that we are trying to fit long sort of secular trends. We are not going to be doing something which is at a very micro frequency. So we are not going to be interested in dynamics. So you can think about these as static cross sections, really, that what we are doing. And there are a bunch of very important things, including things that were discussed in the earlier paper that we are not focused on. For example, the risk-free rate is given exogenously. We are going to allow a bunch of things, though, in a very serious way related to intermediation, where we allow deviations from but let the data tell us how important they might be. So for example, deposits can be special. There could be a deposit franchise. Similarly, banks can be special in lending, and better capitalized banks could be more productive and so on. But these are things that we allow, but we don't impose. We let the data tell us. So back to the map, what's going to be going on in the model. So on the borrower sector side, there's going to be a demand for borrowing products. You can think about the demand for sensitive and insensitive loans, the micro foundation being that some projects require banks for screening and monitoring versus others. This is going to allow us to extract borrower demand shifters, really. Similarly, on the saver side, you can think about demand for saving products. So there could be demand for deposits for liquidity, and there could be other demand related to diversification and so on. Essentially, that side is going to allow us to extract saver demand shifters. And then the big piece is going to be the intermediary sector, which we allow the banks to have the sector to have monopolistic competition so that banks can have rents as they issue loans and deposits. And we also allow interlinkages between assets and liability side because that gets to the various theories of banking out there. So for example, capital allows you to affect lending efficiency potentially. Liquidity, which is securities that you have, allows you to potentially affect your deposit issuance costs. And the idea here is to extract these bank regulatory costs through this middle piece out there. In addition, like I've already mentioned, that bank balance sheets and non-banks are connected because banks can own securities, and there is a joint production which is allowed as well, where banks can directly invest in the non-bank sector. So think about, for example, CLOs, where banks are essential to actual intermediation. Now, very briefly, in terms of talking about how the model is estimated or calibrated, there are going to be 2 pieces which I want to just emphasize. One is, as we sort of talk about the bank side, the bank first order condition is going to imply that there's a relation between a bunch of observed returns, so returns on loans, returns on deposits, returns on equity, and bank balance sheet variables. So both the returns and balance sheet variables are observable in data, so we can use GMM to recover the parameters. We sort of recover elasticities for the borrower and saver side, which are in line with the literature. A couple of other comments which tells us that what we are doing is not completely crazy, is that when you look at deposits, they are cheaper to provide when bank has more liquid securities, and similarly, loans have a higher return when bank is well capitalized, which again is in line with what people have found, so it's not completely crazy. The second piece here, which I think I just wanted to mention briefly related to the estimation, is the normalization that we do. The saver demand is going to be measured relative to deposits. So when I show you anything, it's measured relative to deposits. The borrower demand is going to be measured relative to informationally sensitive loans because they are normalized to 1. And the proportion of sensitive to insensitive projects are estimated once because we cannot estimate that as well as other parameters which are varying over time. So when we allow the other parameters to vary over time, we can look at the data and see what we are finding and map it to the facts and trends that I showed you before. And essentially, we don't think what we are finding is unreasonable. So for example, here on the left, what I'm showing you is the wedges or the spread where the payments that the savers receive versus what borrowers make to the non-bank sector is essentially plotted here. So this is like implicit cost. So essentially what this is telling you is, if you look at the two lines there, one is the government and the other is the private sector, the securitization technology cost is going down, which means the non-bank sector is becoming more efficient over time. And the decline in these estimates line up with the trends that I showed you before. Similarly, on the right-hand side is saver preferences for debt securities. And what you see is that the demand of savers relative to deposits kind of goes up for both government and private securities around the time when I showed you that the shadow money and the shadow sector kind of exploded. So that kind of lines up pretty well as well. And lastly, if I look at the estimation of bank subsidies, on the left, the numbers are too small. But on the left, what I'm plotting is subsidies on the bank loan side, and on the right-hand side, among other things, are subsidies to the deposits and to the bank equity. Again, the levels are not identified in any of these things because of the normalization, but trends are. So on the left, when you look at the subsidy on the loan side, what this is telling you is actually the subsidy is going down. The costs are actually increasing, and there is a much higher increase in cost post the 2007 crisis. On the right-hand side, it's telling you that if you look at the subsidies to the deposit and equity side, it's kind of going up, especially post the 2007. So you can think about too big to fail kicking in a very explicit manner. In the work that we are doing right now, what we do is we take all of these time series estimates that we have and project it on various things like regulation indices, technology indices, wealth share of intangible versus tangible projects in the economy to allow us to interpret this, but this is still work in progress. So looking forward to hearing your comments as well as our discussion on this. So in the last few minutes that I have, let me just tell you the two things that I said that the model allows us to do. One is it allows us to decompose the lending on and off balance sheet. So what's this exercise? We look at the world with 1963 parameters and then iteratively change the other parameters to see how much of lending would change both on the balance sheet and in total. So you can change securitization efficiency, you can change saver preferences, you can change subsidies, and then all of them together. So what is the bottom line here that is worth sort of talking about? So bank balance sheet lending on the left and total lending on the right. When technology changes, so you can think about this as saying that non-bank intermediation becomes more efficient, total lending increases while the bank balance sheet lending shrinks. And like I said, the reason is because you have substitutes now available, so non-bank intermediation allows you to dampen any effect of bank balance sheet contracting. Similarly, you can ask the question about preferences, which is saver demand, as well as bank wedges. Both of them tend to reduce the bank balance sheet. So for example, if the saver preferences is that moving away from deposits, like I showed you, that means that bank balance sheet is going to contract potentially, and that has some effect on lending, but not as much because non-banks can substitute and so on. Together, you can see that what this says is that bank balance sheet is not the same as total lending, because total lending actually goes up while bank balance sheet lending contracts at the same time. We can see this in one more way, which is the last exercise that I'm going to talk about, which is you can take a counterfactual where you increase the capital requirements pretty dramatically and ask the question, what does it do to bank balance sheet and total lending in 1963 and 2023? So what do you find? You find that there is a large effect on bank balance sheet lending, both in 63 and 2023, whereas the total lending doesn't get affected as much. The effects are much stronger in 1963 over 2023. Why is this the case? Some of this intuition should already be clear to you because of what I said before. So essentially, non-banks can potentially be good substitutes for bank credit. That's what tells you why the total effect is smaller. And also, when banks are contracting, the first order adjustment is on bank security holdings. And of course, both of these things are on steroids in 2023 relative to 63. That's why the effects are so much different between the two years. So this sort of gets to the point that I said before, that like when you look at the aggregate, it doesn't seem like bank balance sheet getting impaired affects total lending, at least as the economy stands in the US. So there's a bunch of robustness, but I'm running out of time. So let me conclude. So we try to argue that there's a very important trend over the last 60 years, which is worth sort of noticing. If you zoom back, bank balance sheet lending has declined. This has implications for macroprudential and financial regulation. As you can see in the Basel III discussion, this fact is completely forgotten. We think that this is quite important because bank substitution effect clearly is dominating any other view you might have where bank-centric view is very critical for total lending. It might be critical for many other things, but for total lending, which is the source of discussions, doesn't seem to be as important. What does this sort of tell us in conclusion? It tells us that as regulators are thinking about policy analysis, we got to think a little bit more broadly. What that also means is collecting data not just on bank balance sheet call reports, but also non-banks, and also trying to understand where banks and non-banks are competing and where there are complements, because that obviously plays a role in all of the quantitative exercise that I did. So thank you.
So the discussion is going to be Neeltje van Horen, who is a senior research advisor at the Bank of England, a professor of financial economics at the University of Amsterdam. And while you take the microphone, I just want to say, I don't think that in Europe we have forgotten about all these things. So there is actually a consultation by the European Commission about the macroprudential implications and potential changes needed about the non-bank financial intermediation. And on the data issues you mentioned, you're probably aware, I mean, there are huge initiatives and workforces, task forces under the Financial Stability Board, and we are an integrative part of that. But that's going away from the paper, so Neeltje will give the discussion, 15 minutes.
Thank you very much, Philip, and thank you for inviting me to discuss this paper. It's been a great paper to think about, because we don't often look at like secular changes. We often look at what happens around crisis or shocks, and it's really nice to take this broader view. So let me just quickly recap the paper. It's a very rich paper, and it has 3 key contributions. So the first one is that it documents 3 secular trends in the US bank balance sheet. The second one, that the authors develop a model where there is an interaction between the bank balance sheet and the OTD. And that helps to understand the drivers behind trends, and particularly also how the drivers are differentially important in different points in time. And finally, they assess the impact of capital and liquidity requirements in the 1960s versus now, in line of these changing trends. So what are the 3 secular trends? So the first one is a sharp decline in informationally sensitive bank balance sheet lending. The second one is a decline in the deposit share of savings, and in the paper it implicitly, the idea behind it is it's household savings, but I will get into that in a second. And the third one is that the loans as percentages of bank assets dropped. So the model then looks at three different trends behind these different, three different drivers behind these trends. So the first one is the technological improvements in debt securities issuance. And that drive was very dominant in the early phase, so in the 1970s and to 90s. And it predominantly drove the changes in aggregate lending. Then the second one is a shift in saver preferences that was predominant in the mid-1980s to 2000s, and that had a biggest impact on the bank balance sheet size and the amount of deposit funding. And finally, it's the involvement of government regulations, and particularly after the global financial crisis, and that altered, had the biggest impact on the balance sheet composition. Then the final part of the paper, which I think is particularly important and intriguing, is the changing impact of capital and liquidity regulations. So we see that a tightening of these regulations now, because of these changes in the bank balance sheet, has less an impact in total lending, because there is now more ability of a substitution between banks' balance sheet loans and debt securities. So that's the paper in a nutshell, and I think it's a very nice way to look at starting to think about all these big changes that have occurred. So the key takeaway is that the financial sector now is more resilient to regulatory changes due to shifts in household preferences and declining frictions in OTD intermediation. So what I want to do in my discussion, I want to think about a little bit other trends that have not necessarily been focused on in the paper, which really looks at broad aggregate trends. But so I want to look at the trends in corporate savings. I would like to see a little bit the differences in household versus corporate borrowers, and then on the banking side, the trends in banking concentration. So let's start with corporate savings. So the savings behavior, this is a statement from the paper, it states savers' behavior rather than borrower demand or bank lending opportunities has become a key driver in determining the size and composition of the bank's balance sheet. And I think that's a very important statement. But underneath the model and the thinking, I think, behind the paper is that the paper basically focuses on the savings behavior of households. So I would like to have a look in what happened in the corporate saving side. So we see this is a paper that looks at the diverging trends in corporate and household savings across the world. And you see that there is an increase in corporate savings relative to household savings. And this is the average across countries, but they document that this has these trends you see in various countries and across various industries. So there's been quite a rich literature, quite a recent literature, focusing on what are these drivers increased corporate savings. There is the paper that I showed you, the graph about shows its increases in firm profits. There is also a precautionary savings motive after shocks. There is papers that show that firms tend to save more because of R&D intensive IPOs. And there is a desire to minimize taxes. And finally, there's, of course, this overarching idea that when you have high cash holdings, it's easier to fund investment opportunities outright, or you can secure better loan terms. Often when we think of these drivers and when we think about corporate savings, we think about the big multinationals, the Apples, Microsoft, Alphabet. They have huge savings, and they also have very sophisticated ways of dealing with those savings. So they probably don't hold them as deposits in the banking sector. But if we start looking into this a bit more clearly, there seems to be a drive of corporate savings in the banking sector as well. So this paper looks at the secular trend in US corporate savings, and what it shows is that cash held by US companies increased from 1 trillion in 1994 to 4 trillion in 2016, and according to the paper, it's now 5.8 trillion in 2022. So there's a huge increase. Of course, this is the increase is by and large driven by multinationals. And what this paper shows, it's not the full period, it shows this for 1998 to 2008. It shows that the green line and the blue line, that's what multinationals are saving. And these multinationals save a relatively small amount in the US financial sector because they redirect their savings to other countries where taxes are lower. However, what I want to point at is the red dots, because these are the non-multinational domestic corporates in the US. And what you see is that their savings are high and that they also have increased in this 10-year period, that's doubled as well. So if you look then at the corporate savings on banks' balance sheets, then you see there is a sharp secular trend here as well. So we see a secular increase, and it's also quite volatile, of corporate deposits. So if we think about secular changes in saver preferences, I think it would be very interesting to take these corporates into account as well. So what I would like to see is what is the share and the composition of deposits on the bank's balance sheet? Do we see a secular shift towards corporate savings relative to household savings? And also, if you think about the technologies or the technical changes, they seem to relate mostly to the household savings sector and not so much to the corporate savings. So I can imagine that these trends and the drivers behind these trends are very different. This can have implications for the model, because should we expect that the utility weight and the substitutability of these two savers segments are similar or different? I don't know, but we do know that there is a differential behavior to shocks of corporate deposit holders. They tend to be more flighty when there is problems in the banking in a bank, as we saw in SVB, but also other banks. They might also be more responsive to business cycle fluctuations. So my second point is a little bit related, but then goes to the borrower demand side. So if we think about the lending technologies in the 1960s, this is of course an extreme simplification, but there is a demand for either info-sensitive or info-insensitive loans. In the 1960s, by and large, the household sector, the SMEs, and the large corporates were only able to borrow information-sensitive loans. If we then compare this to 2023, then we see a huge shift because of many of these technological changes. The household sector, and particularly in the US, there is a huge demand or preference or supply of information-insensitive loans because of these conforming loans in the mortgage market. The jumbo loans, which would be the information-sensitive loans, are presumably a much smaller share of the total lending and the total preferences as well from the borrower sector. If we then look at the SMEs, they might have some access to the bond market. In Europe, very, very limited. But let's say, for argument's sake, that the SMEs can only borrow information-sensitive loans. The corporates, they have the big corporates, the multinationals and the large firms, they can borrow both information-sensitive and information-insensitive loans. So if you then think of this in terms a bit of the model, so for the households, there would be a high preference of information-insensitive borrowing and limited substitutability. Most mortgage holders can only borrow one type. And the trend is towards information-insensitive loans. The corporates is a very different story. So the preferences or even the ability to borrow information-sensitive loans and the substitutability really depends on the corporate type. On the aggregate, which is of course driven by the large corporates, we see that there is a trend towards insensitive loans, but probably less so than the households. And for the SMEs, there is likely no changes in preference or ability to borrow. And this is kind of what you see in your data as well. There is a huge, clear secular decline in mortgage lending. That's the left graph. But if we look at the right graph, and then particularly in it's the purple line, the lowest line, You see there is some secular decline in corporate lending, but much less pronounced than what we see in the mortgage market. But when we then go to the model, we kind of have a representative borrower, which is all non-government net borrowers in the economy, which is explicitly, it's a combination of the household and the firm. And also the time series information on the sensitive and the insensitive loans are taking these two segments together, and the key parameters as well. And then there is an underlying assumption that the composition of financiable projects is largely fixed over time. So when you think about these different trends, different secular trends, I'm not so sure that this is a reasonable assumption. And I wonder, and I think that's possible, if you could separate in your model the household and the corporate borrowers and look at these different trends. This matters if you also think about in the changed impact of the tightening of the capital and liquidity ratio. So what the paper shows, or what the model shows, is that the tightening of the capital or the liquidity ratio has now a weaker impact on total lending. And mainly due to a reallocation or the ability to reallocate the credit. So it's a substitution of the information sensitive to the information insensitive lending. Initially you would think it's good news, but if you think a bit deeper, I think no. That's not good news, because to some extent, what we saw in the 1960s, when there is a tightening of the capital ratio, that all segments would be more or less equally affected. There might be a little bit of shift because banks might want more lending to sectors that have more information, for example, but not because of this substitution. Currently, the different segments are very differently affected. The households might even benefit, because if there is a shift to banks wanting information insensitive loans, they might be more willing to lend conforming mortgages. The large corporates, I would suggest, can substitute, so they're mostly unaffected. But then the SMEs will take the full brunt because they have no ability, and the banks are pulling out of information sensitive lending. So in a way, there is the shift, to me, the secular shift, is that there is a market segmentation in the impact of a tightening. And I think the model can, once you start differentiating between the different segments in the borrower market, you can potentially shed light on this. So the last point in the last minute and a half has to do with, this is of course aggregates, and it's really great to look at the aggregates, but the aggregates are driven obviously by the large banks in the economy. And in the US, it's a very, very concentrated market. This is the US landscape in 2016. And if you look at the big four, and then the second one, the 111 institutions in light blue, in total, these banks capture more than 80% of all the bank assets. Does this matter in the secular trends? Yes, it seems to matter quite a great deal, because we also see, and this graphs, I couldn't get data before 2000, but this graph shows a big increase, doubling of the concentration of the US banking sector over time. So the question then is, are the sector changes bank balance sheet general? Or is it a lot of the change that we observe has to do with the increased concentration and the increased role of these very big key banks? And do we see like an increased heterogeneity or a segmentation in the financial system due to these trends and in combination with this increase in concentration? So to conclude, I think this paper provides a really great insights in how banks' balance sheets have changed over the past 60 years, and including the drivers and the implications of it. My wish list for this, or presumably for a future paper, because the current paper is already very rich, is to add the corporate savings and to also differentiate between the mortgage and the corporate lending market, and in particularly the SMEs versus the large corporates. Thank you.
Thank you very much, Neeltjes. While the audience gathers its thoughts, maybe you want to relate?
Yeah, thanks a lot for excellent discussion and great points here. I'll just say briefly about the 3 points that you raised. The point about corporate savings is a very a well-taken point. Right now, what we have in the data is savings of the non-financial sector together, but we could try to separate it out and see what we get. The second point, which is kind of related, is about the borrower demand and different segments. I think that's a very reasonable suggestion. One complication that we face when we are estimating the model is you need to see the returns of in the long time series for returns made to loans to SMEs, to households, to big corporate sectors separately to be able to tease out and do quantitative exercise. Right now, the series that's available going back in time is at a very aggregated level. So if we can find it, the machinery can easily accommodate that. But I agree with you. That's something that's been part of and parcel. Luke actually had discussed our paper and raised something similar. So this is something that we should try to do. I'll say just one thing about the concentration. I think you're exactly right that the concentration sort of kicked up big time post especially the financial crisis. If you look at most of the secular changes, they happened in 80s and 90s. So I think this probably gets more to the subsidies and the costs of regulation that are being imposed and we are extracting from the data. I think you're right that those costs are probably falling more on certain types of banks, smaller, medium-sized banks, and not the big banks. And there might be something that we can do there and look at it as well. So thanks and great discussion. Thank you.
Thank you, Amit. Questions? Marie? Start with Marie.
Marie Hoerova, ECB. So you focused on lending, and you argued very convincingly that total lending is very resilient because there is a substitution from banks to non-banks when banks are constrained. So from the point of view on the metric of lending, seems like good news, and I was wondering whether it is good news. There are other metrics. You can look at financial stability, for example, and then you can argue, well, lending might be shifting to non-banks, they're less regulated, should we be worried? So I was wondering about your thoughts on the welfare or efficiency implications of these trends. Thank you.
Should we collect?
Let's know. Well, go ahead. We'll answer that one.
Yeah, you're exactly right that we don't look at risk, partly because it's difficult to measure this. We've tried to do this in a more comprehensive manner, only looking at mortgages, because there we can do all that. And it doesn't seem, at least in the last 15 years, that risk is something that's, there's this view that like if you increase the non-bank sector, risk will just migrate there and that's a problem potentially. You don't see that, at least in the last 15 years, in the mortgage sector. That doesn't mean that it's not going to happen in the other spaces. This gets to the whole debate about whole fintech and big tech lending, and are these AI models going to be cycle-proof, or is this just going to be overfitting of data and so on? Remains to be seen. We don't have the data to be able to answer that for the entire sector that we are looking at, but it's something that we want to sort of think about, and it's a very fair point.
Yeah, it's going to be critical for your prudential conclusion you had mentioned, no?
Yes.
You have the data. So I saw Livio first and then Jérôme next.
So thank you. So Livio Stracca, ECB. So my question is a bit similar to the previous one, and also one of the points made by the discussants. So if you believe that that banking is special, that the banks have a deposit franchise and therefore they can produce lending or loans or lending in a cheaper, more efficient way than non-bank intermediaries, and there is a huge literature on that, on fractional. So what I mean, I guess the consequence of that is that the shift towards non-bank should increase the cost of credit. So in other words, the bank should be able to produce lending in the cheaper, in a cheaper way for borrowers than NBFIs. Which is also related to the point on SMEs made by the discussant. So do you find that, is it an outcome that? Because that would be a very important point, because right now there is a lot of discussion about bank disintermediation, due to, say, in Europe, we're going to be introducing the digital euro, for example, and banks complain that there is disintermediation. So what is the cost of this? No, because it doesn't seem to show on the total lending, but it shows in the cost of lending. Thank you.
Yeah, that's the reason that we are trying to measure the wedge between bank and non-bank, so sensitive and informationally insensitive. And the way to think about it is that everything else is the same. If the market share of non-banks is increasing, that's telling you that over time, that the efficiency of this non-bank sector is going up. That's the only way the market share otherwise wouldn't move to the non-bank sector over time. Put another way, like with all the hard information, with all the different kind of models available out there, maybe it's still the case that banks are special, but they are not needed for many of the loans which can be outsourced, because what banks used to do, like with the loan officers and all those kinds of things, maybe with technology and other things, that information is available out there, and that wedge has gone down over time. That's all this is saying. It's not saying that the wedge is such that the bank market share needs to go to zero. It just doesn't need to be as large. And once that happens, the system is more resilient as far as total lending is concerned, your point notwithstanding.
Jean Monnet, European Central Bank. So it seems you've triggered a lot of interest for colleagues here. I think having the US-only approach on this is, of course, triggering interest on our side and like forward-looking trends or whatever. My questions relate a bit to a different thing, the asset sides of what you've been presenting. And I'm wondering whether your setup could capture or can capture two features that have to do with equity holdings by households. Because you mentioned the saving preferences. I could figure out that if they would sort of go more into equity, if you look at equity prices, there could be triggers there, or both ways. Supply and demand-driven upward shift in the household's preference, which would mean less deposits for the banks and less lending at the end of the day, just on what you said on other aspects. The second thing is about the relation between non-banks and banks, with a particular focus, as Maria mentioned, Livio as well, financial stability aspects. Non-banks hold or can hold equity of banks, also securities of banks, and this is possibly a sort of channel through which issues on the lending or liquidity side could be anyway going back to banks. So I'm wondering whether you see some concern there and whether, again, you can or could capture that in your setup.
Yeah, so I think on the equity preference of households over time, that's happening in the background, because part of the shift of households or corporates which are lumped together away from deposits means that they are investing in other things like equity. We haven't looked at equity per se, but that's something that we can easily look at. That's a fair point. On the non-bank bank linkages, remember that there is, banks are buying securities that non-banks issue. So there's that linkage. And you're saying that non-banks can also be buying some of the equity of banks and other kind of things, which could create more linkages and potentially create a different kind of channel. We have not looked at that. Actually, most of the non-bank balance sheet data where we can look at more micro level detail, they don't seem to have a lot of other investments they do. It's mainly they originate loans and just originate to distribute. But it's something that could happen in the future. One thing which is worth mentioning, it's outside the scope of this paper, is that if you look at, for example, non-banks getting to the point about risk, in the mortgage sector, which is a pretty big sector in the US, non-banks have a huge market share now in that market. And if you look at the equity of non-banks, equity capital, remember they are not regulated, the equity capital is 25%. So, maybe the market is telling them that, okay, if you're going to be more risky, maybe you're less special than banks, you got to keep more equity. So in that sense, there is more resilience there because that's what the market is demanding. But it's just mortgages. I don't know about the other non-banks. As you know, there's a big debate going on related to private credit, which is all about this.
So that would bring this session to an end. We resume in 22 minutes at 11:10, and it will continue with banking and credit. But let us thank our presenters again with a round of applause.
Good morning to this last session of the DGR Research Conference of the ECB. And my name is Ulrich Binzal. I'm responsible for market infrastructures and payments at the ECB. And this session, as the other sessions, has no title. We have two papers. One is on specialization in banking. The other is on the global credit cycle. But I think the two have something in common, because specialization, I guess, has a regional dimension, can have one, and the global credit cycle has to do something with specialization, or there's regional specialization, so also there we have an overlap. But the papers are very different, you will see, and let me start by introducing very quickly the four panelists. So the speakers and the discussants sitting here all in a panel now. So we have Cecilia Parlatore, who is a professor of finance at the New York Stern School, New York University Stern School. We have Diana Bonfim from Banco de Portugal and European Central Bank and University of Lisbon. Yeah. So 3 affiliations. And then we have Nina Boyashenko from the Federal Reserve Bank of New York, where she is head of the team doing macro financial research. And then we have Stein Claessens, who many of us know for a long time from the BIS, but now Yale University. So let us start with the first paper, which is specialization in banking. And Cecilia, the floor is yours.
Thank you very much, Ulrich. So thank you very much to the conference organizers for inviting me to present. This is joint work with my colleague at NYU, Tony Saunders, and with Christian Blickley, who's at the New York Fed. So I should disclose that the views of the paper do not express those of the Federal Reserve Bank of New York or the Federal Reserve System. So what we're interested here is bank specialization. And if you think, Amit did basically my introduction for me, banks are special. Banks do things that not every other institution does. And in particular, banks are tasked with choosing loans, right? So just figuring out what are good borrowers, how to screen them, but also how to monitor these loans. Once the loans have been made, are the loans keeping up with the covenants? Are the borrowers actually doing what they said they were doing with the money? How do we keep track of where the money has gone? Right? And both of these tasks require some kind of information acquisition on behalf of the banks. And this information acquisition is costly. It's not just something that comes to banks for free. Sometimes they need to invest resources, or they may have some specialized knowledge on it. So once you think of information acquisition and you think of this information that banks need to be able to perform this task of loan selection and loan monitoring, there's a clear economies of scale that can be realized through specialization. Right? And we know that their specialization in banking has been documented in different dimensions. We know that we have relationship lending, which is basically specializing on one single individual firm. We have papers that show that there is regional specialization, or there's specialization on types of collateral, or even in some industries as well. Right? But mostly when we look at industries, at industry specialization, we're thinking of small regional banks. So what we're trying to do in this paper, what we're interested in this paper, is just looking at big banks. It's like, do large US banks specialize in certain industries? That's going to be our main research question. And then if they do, if they specialize, what is it that drives specialization? And finally, if they do specialize, why does it matter? Why should we care about it? So in a nutshell, what we find is that yes, large banks have a preferred industry. Even the large stress-tested banks in the US lend mostly, or they tend to prefer to invest in some industries and not others. What seems to be consistent with is that banks are investing in those industries in which they have informational advantages. And we see this because we see better performance in the industries in which the banks are specialized. And this can be either to better screening or better monitoring. We actually see a little bit of both in the paper. There's evidence of both things. And finally, it's like, why should you listen to me talk for another 22 minutes? Why does it matter that banks specialize? Well, it matters because there's actually aggregate results. right? There's results for both bank stability and for the credit distribution. So as bank stability, we see that there's a little bit of a trade-off between returns and stability, but banks that are specialized tend to have slightly lower returns in the industry with the specialized, but much more stable returns as well. And at the same time, when I'm thinking of the distribution of credit across industries, using a little bit of evidence from COVID, we see that when banks received this influx of deposits, that was a little bit unexpected, that was coming from all of the transfers from the government to the households, then they doubled down on specialization. So if you're thinking, for example, of last year's small banking crisis that we had, when you're thinking of what happens when deposits shift from regional banks to bigger banks, then that's not really innocuous. It's not just enough to say, oh, money's not leaving the banking sector. If it's reallocating within the banks, you can still see that there's effect on credit. Okay, so that's kind of the paper in a nutshell. So let me tell you a little bit of why do I think that bank specialization is related to information. So what are our main hypotheses that we're going to be testing or looking for supporting evidence for them? So the first thing is, like, if you think of what is it that banks do, right? Or what's the objective of banks? Banks, on the one hand, they want to provide resharing to their depositors. And the best way to do that is by investing in diversified portfolios that would eliminate all idiosyncratic risk. And if all banks were exactly identically informed, this is what you would expect. You would expect the same portfolio being held by all banks in the way that would diversify all risks away, or the most that they can away. Now, if you think now of banks' role as information producers, then this is a little bit different, because now if I have an informational advantage that other banks don't have, that would push me towards investing more or giving more loans in those industries in which I actually have better information. Because those loans are going to be less risky from my perspective, because I know something more about them, than from the perspective of the other banks who may be uninformed about these particular characteristics in this industry. So when I think that there's a little bit of this tension between diversification and specialization, and probably the main driver, at least in our view, is that the more a bank knows about a borrower, then the more likely it is for that bank to be lending to that borrower. And again, this idea that this is going to be, there's going to be less uncertainty in general, but also it's less likely that I'm getting a lemon if I know more about this industry, if I know particularly more about this borrower. Right? So there's a lower winner's curse as well. So the first hypothesis that we're going to be testing is whether banks that are constrained, we say that they will specialize in industries in which they have an informational advantage. That's our main hypothesis. Right? Now, how are we going to be thinking of this? Well, if it's true that banks actually have an informational advantage, this should translate into better performance in the loan portfolios of specialized banks. So our second hypothesis is that if informational advantages are going to lead to specialization, then we should see that banks that are specialized should have better performance in their industry of specialization. Right? In the paper, we do much more. Diana had a very long appendix to look through. But these are going to be the two main things that I'm going to be focusing today. And then I'm happy to discuss more after when we're in the break. So how are we going to measure specialization? We're going to use two main measures, and we've done this with a host of other measures, and all of the results are robust. So we're going to use first relative specialization, which is measuring the relative degree of overinvestment that a bank may have in a particular sector. So this is going to be the share that a bank invests in a particular industry, given all of the loan portfolio of that bank, relative to what you would expect to observe if you were to hold the representative loan portfolio in the C&I lending. Okay? So it's kind of like akin to what you would think of deviations from the market portfolio if you were thinking of assets. Right? But this, instead of having the market portfolio, we'll be thinking of what is all of the C&I lending that you have. We can also measure this, instead of thinking in relative terms, we can think of excess specialization. We can think about the differences between these two shares. And both measures are going to give us the same results. We also use the loan count, the log amount. We also have a binary measure for whether this is the top industry for a bank or not. And all of our results are quite robust to using any of these measures. In the paper, we have a long discussion of it. So once we have this measure of specialization, let me tell you a little bit of what's the data that we use to compute it. We're going to use mostly Y14 at the quarterly frequency. And this covers all stress-tested banks in the US From 2012 to 2020, we have 40 banks. It tracks all C&I lending loans of over $1 million. And so we have a lot of observations here. And the most interesting thing is that we have the amount of the loan, the rate, the collateral that we use, the internal rating, the performance. We have a lot of measures that are going to allow us to kind of tease out a little bit this difference in information that we're proposing. We're going to be focusing on term loans. We've done some on lines of credit as well, some analysis, and the results still remain. We're also going to use some publicly available data on bank balance sheets and from White Skull data and 19C. And we also use S&C data for additional tests when we want to look a little bit of how robust are our results when we go down the distribution of size, right? Because the Y14, of course, is going to be biased towards large banks, but maybe there's something else that we can do by looking at smaller ones. And then for that, we use S&C data. And so let me show you what we get using this Y14 data. And we get a measure of excess specialization. So that's the one that I showed you where I have the share of a bank's loan portfolio in a particular industry relative to what you would get in the representative bank. Then you see the orange line there is for the top industry of each of these banks. This is the average across all banks. The gray line, which is the second one, is the second industry. And then the black line is for all other banks. Right? And you can see that there's a clear difference. Right? For the top industry, excess specialization is much larger. And this is something that's consistent across all banks. And maybe banks seem to have like maybe one or two like preferred industries. But for the rest, they're pretty close to being average. So this is a pattern that for us was surprising a little bit, was salient. It's like even the big banks in the US tend to have one or two preferred industries in which they overinvest relative to the average bank in the industry. And also we have a huge heterogeneity in the degree of excess specialization, of course, and we also don't have, given the measure, the nature of our measure, I can guarantee that we don't have all banks specializing in the same industry. It's not that just one industry is large and therefore the loan amount is larger for all banks in that industry. That's not what's going on here. Okay. So if you actually want to look at loan performance, because like my first hypothesis was like, well, if this is driven by informational advantages, then we should see better performance in those industries in which banks actually specialize. So this is just raw data. I'm just plotting the number of loans that become non-performing in the y-axis relative to our measure of relative specialization in the x-axis. And you can see that the more specialized a bank is in an industry, the lower the non-performing rate in that particular industry. Which again, this is our first hypothesis kind of telling us, well, there may be something in terms of how much banks know in the industry of specialization. This is kind of like our first pass. Now, of course, we do regression analysis, which is much more detailed. And what we're going to do is to regress our outcomes, which can be exponent those performances. And then we're also going to look at the terms of the loans. And we regress this on specialization. And we use all of our different measures that I mentioned a few slides ago, and we include a lot of controls. And I think this is really important because we're going to control for relationship lending, for geographic concentration or geographic specialization, for industry capture. We're going to try to say, okay, does industry specialization matter beyond all of the other forms of specialization that we know have some effect on the loan terms and the loan decisions, on the lending decisions of banks, right? And all of these regressions also account for bank, industry, loan type, loan purpose, and risk fixed effects. I'm going to point out as relevant, and we actually have a lot of robustness on this. So this is our main regression. And when you look at this regression, our coefficient of interest is going to be the coefficient beta 1 on specialization. Right? That's going to be our main coefficient of interest. So this is not perfect. We have data, and empirical work, sometimes it's messy. So I want to clarify that we are not measuring loan demand. We only have ex-post outcomes. And because we only have ex-post equilibrium outcomes, we cannot identify any exogenous variation in specialization. So everything that I'm going to show you should not be interpreted as causal. These are just, I think, like correlations and patterns that are relevant to understand how the banking sector works better. And I think these are interesting patterns both for academics and for policymakers alike. So this is not that specialization causes better performance, but it's just they're associated with. So going to my first result, like specialization is associated with improved performance in the industry of specialization. So what we do here is we have excess specialization, we have the interest rate, so we're controlling for interest rate for loan amounts. In the last column, we're controlling for the share that a bank may have in a particular portfolio to control for geographics, in a particular SIP to control for geographic specialization. We also think of past relationships to control for relationship lending. And you can see that in all of these regressions, even when we think of specialization as by itself, and when we start adding other types of specialization as well, we still find that there's this negative relation between excess specialization and defaults and non-performing loans, right? Which again, for us, it's the first piece of evidence suggesting that maybe these banks know what they're doing. That when they double down on an industry, when they invest more than what you would expect, or more than the average bank in a particular industry, it's because they're picking better loans. And by the way, we're also controlling by risk ratings. We have risk ratings available, and so we can also kind of, the internal ratings are quite standardized, so across banks, because they have to be approved by bank examiners. So we're also controlling for that in some of the regressions as well. Okay, now I told you that excess specialization in industries mattered beyond other specialization dimensions, and I want to show you that, because I think like that's a key. Of course, excess specialization is correlated with geographic specialization, is correlated with relationship lending. So what we ended up doing here is just running a horse race among all of the most traditional specialization dimensions. So we have excess specialization in the first line there, and you can see we ran it alone. There's a negative relation between non-performing rates and specialization as we measure it. And then if you want to look at like the market power, looking at the share of a portfolio in a particular industry that a bank may be lending, you can also see that's negative. We can also have geographic specialization, and we also have relationship lending. All of them go in the way in which you would expect. The more a bank specializes in any of these dimensions, then the better it performs, the better loans it gets. Now, what we do in column 6, which I think is the most interesting, is we standardize these measures of specialization, like to be 0, 1 distributed, so we can actually compare coefficients. And what you can see is that the one that has the highest magnitude, it's industry specialization. So even when we control for all of these traditional, if you want, types of specialization that the literature has been talking about, we find that industry specialization matters quite a bit, and in fact, is like almost twice as much as the next one. Okay, so this is like 0.007. Here's like the next one is 0.003. So it's twice as much. Again, these are, I don't want to think of the magnitudes, but the relative magnitudes, because what we're doing is standardizing these measures of specialization so that we can actually think of the coefficients, like one standard deviation in specialization that is in industries would change non-performing rates twice as much as one standard deviation in regional concentration. Okay, so we also use other measures of specialization, as I mentioned above. We're measuring excess specialization, relative specialization, the share in the loan bank's portfolio that an industry may represent, and also whether there's the particular industry is the top industry or not, and we still get the same result. So this is quite a robust result that the more specialized bank is, however you want to measure it, the better the loans are in that industry of specialization. Right. So we have additional information, supplemental information about some of the loans, and we can look at more evidence to figure out whether our hypothesis makes sense. And we look at performance and syndication, and we find that non-syndicated loans perform a little bit better than syndicated ones, which would make sense. If I'm syndicating a loan, well, I don't want to give away the loans that I know are better, because the market is not really going to compensate me for that. We also look at constraints, like maybe the specialization that we're looking at is really not driven by information, but by banks being constrained. If there's a fixed cost of me entering an industry, then I'm a small bank. I'm not going to be able to enter many different industries, and I'm going to specialize basically mechanically. We do look at S&C data to kind of tease that out, and we do find that larger banks have a stronger correlation or negative correlation between specialization and non-performing rates. But this is still present in all of the distribution, except for the very small banks. For the very small banks that you would think would be the ones that are constrained, this relationship's no longer there. And that's what we look at. And the SMEs, then, we tend to know that lending to small and medium enterprises is quite opaque. We have less information about these firms. So it would be a sensible thing to observe that banks that know more about the industry are better able to discern among SMEs, and they may be more willing to lend to them, and that's exactly what we find. Okay. Now the question is, like, how do, let me just skip that because I have like 5 here. So why is it that banks actually, or how is it that banks actually get these better borrowers? Because I think like that's the key. I'm showing you that there's this negative correlation. Well, what is it that the specialized banks do to actually be able to win these borrowers that are better? So what we look at is the different loan terms and how they correlate with specialization. And we find that banks that are specialized in a particular industry, in that industry of specialization, they offer lower interest rates, larger loan amounts, longer maturities, and are more likely to lend in an unsecured way. Right? And all of these things, again, point towards banks having better information about those borrowers to whom they're lending. Right? This is not just random. In the paper also we have some simulations where we actually simulate the distribution of loans, just if they were random, and then compute X specialization. And we see that the patterns are quite different than the ones that we observe in the data itself. So I think like all of these things point towards this bank specialization driven by informational advantages. We have that, again, there's more favorable terms for firms that borrow from a bank that's specialized in that industry. And this holds both for newly originated and renegotiations. So it's not just driven by relationship lending, which was a concern when we were looking at the data. And we also know that the loan is more likely to be secured by fixed assets and other types of collateral when the bank is specialized in that industry, which again is consistent with banks needing to have some type of knowledge about the collateral that they're assessing if they want to accept it. And then we show, as I mentioned before, that all of these regressions are controlling for firm by capture of the industry, by geography, and also by previous interactions. So none of these results is driven by relationship lending or geographic concentration or even the market power that's associated with banks being larger in a particular industry. Okay. So in the last few minutes that I have, I want to talk a little bit about why is it that bank specialization matters, right? Well, what we find is that there's 3 dimensions in which it matters. First of all is stability. Then we also look at what happens when banks have tight tier 1 capital. So what happens when these banks are not doing so well. And then we also look at what happens when there's reshuffling of deposits. So first, specialization is associated with better performance in the industry, even in times of industry downturn, right? So if I look at this, it's like, okay, if the industry is not doing that well, but I'm a firm that's borrowing from a specialized bank, I'm going to do a little bit better than the rest of the firms in my industry. That's the first one. We see that reductions in tier 1 capital are associated with rising specialization. So when banks are more constrained on where they can lend, they tend to go for the specialized industry a little bit more than the rest. And when we have shocks to deposits, the same thing happens. So either for inflows or when periods of restrictions on the lending that the bank has, in both cases, banks adjust more on the upside on the specialized firms, on the specialized industry, but they also reduce the lending less in the specialized industry. Okay. The caveat here, because then it's a valid question, it's like, well, everything that we're doing is in a time of peace. There's no really a crisis in what we're looking at. And we see that there's lower returns for the banks that specialize more. So specialization is associated with lower returns, but they're a little bit more stable as well. So let me show you that. So we see that banks can actually buck industry or industry bank trends. You can see the average defaults in the different industries here. This is the regression without controlling for everything. But then we can start including some interaction. So we can look at whether it matters whether the bank is specialized in that industry and figure out what's the industry default rate. And then we can also look at the bank default rate. And we see that this relationship still exists, right? So that's one. We also see that when we have tier 1 capital shifts, so when a bank has tighter capital requirements, then banks gravitate towards their preferred industry. And this may be related to risk weights a little bit because they're lending like in a safer way, then it may be easier for them to do that. And that's what you see in these two figures. And then finally, when we looked at COVID, we see that these inflows that were completely unexpected are correlated with increases in specialization in the bank's preferred industry. So banks increase their lending in their preferred industry when they receive the deposits, this inflow of deposits during COVID. And our view, and at least what we think that you can actually learn from this, is that just giving deposits to banks or increasing the deposits or having money leave or come into the banking sector, it's not enough to figure out what's going to happen to the credit market. We have to figure out specifically where this money is going. So the heterogeneity in the banking sector, it's really important in determining the conditions that we can face in the credit market. In particular, during COVID, what we observed is that banks increased their specialization after receiving the increase in deposits. So this I'm going to finish here. What I showed you is that large banks specialize by concentrating on a single favorite industry or a few, one or two. Specialization is consistent with banks having informational advantages. We see that the banks have better performance in the industry in which they specialize, and they're able to offer better terms to the firms in those industries. And there's aggregate implications for this. And this is part of a broader agenda that both Christian and I have been tackling, and I'm happy to talk about that if anyone's interested. Thank you so much.
Thank you. Thank you.
Okay, perfect. So thank you so much for the invitation to be here and discuss this really great paper by Cecilia and co-authors on bank specialization. These are going to be my views, not of the ECB or Bank of Portugal. The first thing I want to say is to congratulate Cecilia, Tony, and Christian, because I mean the paper has just been accepted at the Journal of Finance. So this is of course great news, and it's really well deserved. This is a great paper. So I learned about this. I had already kind of looked into the paper, and I was kind of struggling. What is there that I can be helpful with? I mean the paper is really so mature, so advanced, covers so many angles. And indeed, I was very happy to learn that the paper is now coming out in the JF. So well, what I think I can start by doing is kind of the ideology of the paper. I mean, to tell you about, how important, how impactful the paper is and what we learned from it, okay? So I think the starting point of Cecilia and the co-authors was to think about what we know about bank specialization. Okay? And they took this question really very seriously. And I do think that after reading the paper, we do know much more than we would before about how do banks specialize, what are the implications of that, not only in terms of access to credit, in terms of the performance of the loans, and also in terms of the aggregate implications. So this is really a massive, so Cecilia mentioned there's many appendices. This is really thorough, very detailed work. And so it's an impressive effort to really document every single aspect of bank specialization in the United States. And so one big takeaway is that, yes, I mean, banks specialize in the US, and so they lend disproportionately more to some industries than to other industries. And one reason I also like the paper a lot is, I mean, it's an approach like no stone left unturned. Everything we can extract from the data about how the banks specialize, the authors go and they explore that. And so they're also very upfront, as Cecilia was here in the presentation. This is not a paper about causal effects, about having a very accurate identification strategy that allows us to derive some causal implications. But the trade-off of that is that the authors acknowledge these, and they're able to take some bird's eye view and to really establish a set of stylized facts that allow us to collect all this knowledge. And so let me start by kind of summarizing what I think are the things we should remember about this paper. So the first thing is clearly that specialization is important for banks to acquire knowledge, okay? So by learning repeatedly to specific industries, the banks are acquiring knowledge. And so this allows banks to do better what they are supposed to do, which is to screen and to monitor borrowers. So by specializing and lending repeatedly to these firms, the banks are able to select the best borrowers out there, and they're able to make sure they perform well throughout the lifetime of the loans. So what this means is that on one hand, you have lower default rates. Okay, so Cecilia showed us a lot of evidence on that. And at the same time, the paper also includes information about the fact that small firms are more likely to have access to credit if they go to a specialized bank. Then another interesting fact was to see that banks are actively competing for these borrowers. Okay, so specialization is not something random. Banks try to reinforce their specialization by being very competitive and trying to attract the good borrowers in the industries on which they are more specialized. And they do this by offering larger loans, by offering them lower interest rates, and by allowing the firms to borrow at longer maturities. Okay? On collateral, the results are a bit more debatable, but I'll go there in a second. And then, I think another very interesting finding is to look into what does this mean for the banks in terms of their ability to generate returns. And so specialization seems to come at a cost, okay? The fact that the banks choose to go for these lower risk firms on which they know a lot about means that, of course, they cannot extract as higher returns as they would if they would be taking riskier strategies. And this is true, of course, in more tranquil periods. I will also come back to that. Because actually, when the authors look into some of the distress periods that they have in their sample period, what they find is that the banks that are specialized in these industries, they stand ready to give support to the firms in those industries when they're in trouble. Okay, so I will, of course, not suggest more things for Cecilia to add. There's enough appendices. The paper is accepted and very well published. So what I'll try to do is to share with you some thoughts I have on the paper and how can these inform future research and what else can we learn from this. And so my first set of thoughts is about specialization and competition. Okay, so one thing that I was really curious about when reading the paper is to try to understand if these firms that operate in the same industries, okay, are they competing with each other or not, okay? Because the incentives that the banks have to lend to these firms are going to be quite different. So one thing is, okay, these firms operate in the same industry, which means they deliver the same types of products and services, but they might not be competing with each other directly. They might operate in different markets. There might be different targets into what they do. And so if that is the case, the bank is learning something from lending to these firms that operate in the same sector and deliver similar products and services. But by lending to one of these firms, they're not necessarily hurting they're not necessarily hurting their competitors, to which they might also be lending to. If these firms are indeed actively competing with each other, then the story might be somewhat different, right? Because indeed, I mean, if I'm going to give more loans to this firm, this is going to place this firm in a better competitive position compared to the other firms in the same industry with which the firm is competing. And if I'm also lending to those firms, then the balance might not be clear. And so there's this recent paper by Hans de Grijs and co-authors about the idea of asset overhang, which tries to explore this idea, okay? If I have a lot of exposure to a given sector, to a given type of firms, I might want to protect my existing borrowers rather than give loans to new ones. And so I think it would be really interesting to try to go deeper on this issue and to try to disentangle which are the firms that are competing with each other, how does competition work within the industries on which the banks are specialized. And then still on competition, I think it would be interesting to also look a little bit more into how banks compete themselves. Okay, so there's a lot of heterogeneity into the specialization patterns of banks, but one thing that I couldn't find, we didn't have detail in the paper, is to understand if banks compete, how often do banks compete in the same industries? Of course, there's many differences, but I'm sure that in some industries there's going to be some banks that actively compete there, or it might also be the case that banks really try to split the territory and each one is going to focus on different industries. And again, I think we could learn from going deeper on these, because somehow this would allow you to discuss a bit better two things that already show up in the paper, which is to understand what is the role of market power in specialization. Okay, so the fact that the bank is very heavily invested in this industry gives the bank a lot of market power with borrowers from this industry. And this is something that is debated, but at the same time, you have the role of screening, which is kind of the highlight, the way you explain the results more clearly. And so by understanding a little bit better how do banks compete and how do they share the market among themselves, I think we could learn a little bit more about these two forces that might be behind the results. Then another set of thoughts I have is about linking specialization to evergreening, okay? So I think the most clear result in the paper is how clearly banks specialize in industries, and in those industries they focus on these high quality borrowers, okay? And so then this means that this is a low risk strategy, okay? It's also shown in the paper that this leads to less profitability. I actually think here I mean, it would be interesting to come back to this in a few years and have a more complete credit cycle, because of course the low profitability during a good period might be somehow compensated by also having less losses if there's really an increase in aggregate risk. But abstracting from that, I also wonder if there could be something hidden here, okay? And what I mean by that is I wonder if there could be some cases where these lower ex post defaults, lower charge-offs that are clearly documented in the paper are somehow reflecting the bank's incentives to be evergreening, to be somehow hiding losses in industries on which they're already very specialized, okay? So if the bank has a very concentrated exposure to these industries, if things start to go wrong, well, this would be the industries where the banks would perhaps have more incentives to somehow keep lending onto these firms in a way that this avoids them to actually get into a distress situation and actually show losses. It could be on the opposite, okay, that the specialization actually discourages the banks to engage in this type of zombie lending, right? And so here, for instance, Olivier de Jonge has a recent paper published in the Management Science with Belgium data that goes pretty much in the direction of what you're showing here in your own paper, which is to say, well, if the banks are heavily exposed to this industry, then they're not going to support these weaker firms, because by supporting the weaker firms, this is going to have negative spillovers on the firms that they're also lending to and that are currently healthy. So again, this also touches a little bit on the competition story, and I think it would be really interesting to go somewhat deeper on this. Then my third set of comments, thoughts, is about the many dimensions that bank specialization might have, okay? And so in the beginning of the paper, you start by asking where does specialization come from, and I think this kind of really motivates what you have. But then the actual evidence on this, I mean, you have quite some evidence scattered over the many appendices of the paper. But I think the reader would be interested in learning more about this, and maybe there could be a follow-up paper where this is kind of approached with a more hands-on way.
So understanding exactly how this works, is it the firms, and you were very clear here, Cecilia, that you cannot control for demand and all that, but still on the same exploratory level, trying to understand if it's the firms that are selecting these banks, if it's the banks that actually go after the borrowers. Also, I think it would be very interesting to try to uncover what are the differences between some kind of strategic specialization? So this is the business model of the bank, and I want to be specialized in the biotech industry, and so this is where I'm going, as compared to more random-based specialization. So the bank started operating in some specific geography where this industry played a very strong role. And so these are different ways of becoming specialized, and they might have different implications. I think it's also interesting to understand how this changes actually over time, and there's some evidence, I think, scattered again over the paper that this seems to be quite stable, but actually how stable and when is it not stable? I think this is very interesting. So again, I think these are things hidden in the paper. Of course, you couldn't tackle everything, but I think there's a lot of basis here for future research and to work more on that. And this is precisely my point. I think actually all this literature on specialization in banking is really growing a lot recently, right? And so, I mean, very related to your work, I think, I mean, for instance, again, citing Olivia's work, I mean, there's this new paper about specialization and innovation. I'm working myself on specialization and startups. There's a recent very nice paper by Laura Alfaro looking into specialization and global value chains. You also cited this paper by Jean Monnet about specialization and control rights. And so actually, there's I mean, something else that I would encourage the audience that might be interested on this. So Veronica Rappaport, when recently Philip Schnabel and Daniel Paravizini and Veronica won the Brattle Group Prize in Corporate Finance from the Journal of Finance, you can see online a very interesting presentation by Veronica where precisely she mentions your paper and some of these papers here and really sets the stage for all the future research we might have on this topic. And the very last issue I would like to raise is about, I mean, what are the policy implications? And I think here the paper is quite silent. I mean, is there any kind of policy lesson that we might take from this? And here, I mean, I think there's clearly a lot of food for thought, and there's really a lot of evidence out there. So my main question here is whether we believe that bank specialization should somehow be encouraged, because the results seem to be quite positive overall in terms of risk-taking and in terms of financial stability and access to credit. So, of course, this makes me wonder, I mean, part of the regulation that we have actually goes in the opposite direction, okay? So for instance, the large exposures regime actually puts brakes into how much banks can be exposed to certain borrowers or in some cases, some industries. Also, I mean, in terms of macroprudential measures, sectoral capital buffers are going to hit some banks much more than others. And also, I mean, of course, in the paper, the period you're covering is a relatively stable period, but there might be a negative side to this specialization if somehow there's a systemic event that is going to make some of these more heavily specialized banks particularly affected, and that lead to contagion in the system. So to sum up, I think, I mean, this is a paper, I started with analogy, but actually I think it's the opposite. The paper has just been published, and the paper I'm sure will have a very long life, because I mean, it's really a masterpiece where you document all these very important findings and results about bank specialization. So I would take it as mandatory reading for whoever is interested in learning more about how banks work. And I mean, so as you could see, I think the paper itself lends itself to create many other new questions, and I'm sure there's going to be a lot of research coming out of this. Thank you so much.
Yeah. Thank you, Diana. And I totally agree with the conclusion. It's a great paper, but it raises a lot of questions on how to interpret it, and one has a lot of ideas on more research that could be done on that basis. So we have, I think, 10 minutes for questions, and you are supposed to stand up and say where you are from when you are given the floor.
So while the mic comes, thank you so much for a very generous discussion, and you hit on the nail. Like, there's nothing we can say about policy because we have a very quiet period of time, and you don't want to say, oh, specialization is good. It's like, yeah, if nothing happens, sure. And then some of the research that we're doing on competition among specialized banks, we have a follow-up paper that combines measurement and data and theory that kind of looks into that. But thank you so much.
Simone Manganelli, ECB. And linking to the presentation of the previous session, was wondering if you have any evidence about long-term trends in specialization, and whether what you see in the last decade is just an endogenous outcome of this secular decline in bank lending that we saw in the previous session.
I think it's very interesting. We were discussing that with Amit actually in the break. It's like we have 10 years, we don't have more. This is FY14 data. We needed pricing data as well. So no, I wish we had. Hopefully in a couple of years we can say something else. For now, over these 10 years, specialization is quite stable though. There's, yeah, that's my answer.
Please, yeah.
Hi, Amit Seru from Stanford. So one of the things which is related to the point that discussant raised is that specialization could have implications when the bank fails, because the willingness to pay for your potential bidders is going to be a function of whether they are specialized, and that kind of interacts with if the banks are well capitalized as potential bidders. In fact, we had looked at the previous 10 years around the 2007 crisis. We had a bunch of failures, and you find that banks that are very specialized, especially if the potential bidders who are specialized don't have a lot of capital, which happens during bad times, there's a huge discount in selling those banks. So I wonder if some of the returns results that you're getting is actually pricing those states of the world where if bad stuff happens, you will not be able to sell for as much, potentially. So that might be worth sort of exploring potentially.
I think that's a great point. So we can't say anything about downturns. Now, the other very specific thing about this data is that these are huge banks. So they're very, very, very heavily regulated. If you were to look at regional banks, I don't know whether the return and the risk relationship that we're observing will be there, even in normal times. So that's a big caveat. It's peaceful times, and these are stress-tested banks. So we don't have an SBB in our data set. So but it's a very good point.
Thanks. You want?
Maria Horova, ECB. Actually, I had the same question as Simone, but maybe on this you don't have much of a time series, but can you think of across industries whether there are differences in how tough the competition from non-banks is? Perhaps it differs across industries, and whether you can do some kind of cross-sectional heterogeneity across industries on that. And maybe another question is, so again, you looked at borrowers and lending, but I guess banks are providing packages, right? I mean, there is also something, there's a deposit this borrower has with the bank. Do you have any sense whether there is some cross-subsidization going on across different products that the bank offers different borrowers? Because, you found that, they kind of provide these very lucrative terms to the specialized borrowers they have. Do you have any sense of what they do on the other side with other products? Thanks.
So we haven't looked at bundling. I think it's really interesting to kind of look across products and figure out if this is just cross-subsidization for something else that they're charging them more for. We haven't done that. One of our students, Yanis Kaposiaras, is working on actually looking at what happens after, kind of tracing the relationship. Maybe it's an initial low return and then it starts growing up with time. So that may be another thing that's happening. But we haven't looked at that in the context of this data. And on the previous thing, whether we actually have results that if you look at industries that have more non-bank lenders that are prevalent as a share of the total lending in that industry, then banks offer even better terms than they would offer in the others. So there's a little bit of that, and who's competing against me? Is it other specialized banks? Is it just non-specialized banks, or is it non-bank lenders? So we have explored a little bit of those results. I think that maybe now are in the appendix, and we're not giving them so much prevalence. But yeah.
What, David?
My question goes a little bit in the line of that of Amit, in the sense that if you have an increase of specialization, you might think also that banks have more market power over certain industries. So I would like to know your thoughts on that. I understand Y14 is 40 banks, and you might not have interest rates. So have you thought about that dark aspect of specialization? And on the positive side, just to keep it a bit lighter, obviously a specialization would matter much more in the direction of that Diana was alluding to, which is on the equity side. So do you see an increase in specialization on the equity side, not from banks, but maybe from venture capitalists, private equity, etc.? Thank you.
So starting on the second question, we haven't looked at equity side. I think it's really interesting to figure out whether there's specialization in that area as well. If the intuition translates, then there should be, because there's some informational advantage when you kind of lend more in one industry. Anecdotally, I would say yes, there is, because the people that I know that run VCs tend to focus on one or two industries. And I think we're out of time, but I'm happy to talk more afterwards.
Yeah. Can I also ask a question?
Oh, yeah.
Sure.
So like, I'm trying to stay.
One intuition that I had, I was surprised by the result that specialized loans have lower rates now. Because you could say, where it matters to specialize is where you have information-intensive projects, and then you do the work of monitoring, but you would be compensated, you should be compensated for the investment into information and monitoring, while when you have plain vanilla projects that everybody understands immediately, you don't have this cost factor, so why couldn't you have also the opposite?
So we're controlling for risk in our regression, so we're trying to kind of think of two projects that are as information intensive, if you want, and then see whether the specialized banks do better.
Yeah. Okay, so great paper, many thanks. And you saw a lot of questions, but you answered very efficiently, so that worked out. Okay, let's move on then. The global credit cycle. Nina.
Thanks for having me, and thanks for having the paper on the program. This is joint work with my colleague at the New York Fed, Leonardo Elias, and again, as Cecilia said, the views are our own and not necessarily the views of the bank or of the Federal Reserve System. So the starting point for our paper is to think about whether there is a global component to local credit cycles. So we're actually, in some sense, going to go the opposite direction of what Cecilia was looking at. And one way to think about where we're starting from is to think about the recent literature on the global financial cycles and the parallel recent literature on local credit cycles. So the global financial cycle literature thinks about common variation in global asset prices. And one of the things that literature documents is that you can construct a single factor, the so-called global financial cycle factor, that is going to explain a large fraction of the common variation in a range of global asset prices, so across different types of asset classes as well as across different countries. And that literature has shown that, at least historically, that factor tends to be strongly correlated with measures of equity volatility in the US, so with something like the VIX. At the same time, post-crisis, we have focused a lot on trying to understand the relationship between local credit cycles and local macroeconomic outcomes. And that literature tends to find that local credit growth is going to predict things like adverse future real outcomes. And in particular, if you have expansions in the quantity of credit that happen at the same time as there is a compression in the price of credit, that tends to predate even worse outcomes than if you just have an expansion in the quantity of credit or you just have a compression in the pricing of credit. So one question we're going to be interested in studying is why could there be a global component to local credit cycles? So if we think about what the global financial cycle literature is trying to measure, one way of interpreting the factor, the global financial cycle factor, is that it proxies for global risk aversion in the banking sector. When that factor signals tightening, that corresponds to decreases in the quantity of bank-provided credit locally. You can also think of that factor as proxying for global risk premia, so that, again, tightenings in that factor correspond to, or rather loosening in that factor correspond to decreases in local credit spreads. Now, one thing that we're going to try to argue in this paper is that the global financial cycle factor is potentially not the quote-unquote right measure of global credit cycles. Why? Well, one feature is going to be that the global financial cycle factor tends to look a lot like a banking credit factor or an equity credit factor. And as the world moves towards less dependence on bank intermediated credit, it's potentially a less representative measure of cycles around the world. And also, we're going to argue that there is a differential pricing of volatility in equity and corporate bond markets. And so to the extent that the traditional global financial cycle factor captures a lot of equity type measures, it's potentially going to be mismeasuring the global credit cycle. So what do we do in this paper? The first thing we're going to do is construct a measure of the global credit cycle. I will show you a little bit of the details of the procedure, but essentially we're going to try to construct a factor that's going to predict 1 month ahead bond level returns, 1 month ahead country level equity returns in a large panel of countries. And we're going to build that factor to be nonlinear in measures of aggregate credit spreads and aggregate volatility. From an econometric perspective, we're going to implement this procedure using reduced rank regressions. Once we construct our global credit cycle metric, we're going to do a few things with the factors that we construct. First, we're going to show that the global credit factor is going to predict asset returns. And we can slice and dice the data in different ways, so looking at specific countries, specific subsamples, predictive horizons, and asset classes. And one of the nice things that comes out is that we do have monotonic factor loadings, so both within a country across asset classes as well as across countries. And in particular, that monotonic factor loading kind of looks like a flight to safety. So we're going to have lower expected returns for safest, higher expected returns for riskiest, either asset classes or countries following a credit factor tightening. The second half of the paper focuses on trying to understand the relationship between the global credit factor and local macroeconomic outcomes. So the first thing we're going to show you is that tightenings in the global credit factor predict changes in the local quantities of credit. So first, it predicts extreme capital flow events, in particular capital flow events in debt portfolios. Second, we're going to show you that it predicts declines in the stock of private debt outstanding. And kind of corresponding to what the local credit cycle literature has found, we're then going to be able to predict local real activity. And both looking at the mean, so we're going to be able to predict that a tightening in the global credit cycle predicts lower GDP growth locally, as well as a higher probability of extreme negative GDP outcomes. Finally, I will show you just a little bit of this. We do find this predictability both in and out of sample, again, lending credibility to the global credit cycle factor that we construct. So just to summarize, essentially, what are we finding? So a tightening in the global credit cycle is going to correspond to a higher probability of debt portfolio flow stops, is going to correspond to a slowdown in growth, and is going to correspond to a higher probability of quote-unquote growth crises. So let me tell you a little bit about the data that we're going to be using. So the main data set is going to be focusing on very detailed secondary market data for corporate bonds. We're putting together a longer history of pricing data for the US, which starts in 1973, together with global corporate bond indices for both investment grade and high yield bonds. One of the drawbacks of the international corporate bond data is that it only starts in 97, which is why we are supplementing it with a longer history of US data. One of the key things that we're going to be doing is we are going to be adjusting our realized or predicted returns for firm level default frequencies. We get that from Moody's KMV Credit Edge. And essentially, the default frequencies in that data set are based off a Merton model. We have a companion paper where we explain how to put all of this and other data on international debt markets together. So just to give you an idea of what these returns look like over time, so here I'm just showing you the advanced economy subset of the countries that we're going to be looking at, plotting 12 months cumulative excess returns at an aggregate country level. And as you can already see from this chart, there's a lot of international movement in these bond prices, but you do also importantly have periods where particular countries deviate from the aggregate trend. For example, due to their particular exposure to specific macroeconomic factors that are not global. In terms of how we're going to be constructing our factors, again, I'm not going to go into the details in the interest of time, but let me just give you a flavor of what we're doing. So essentially, we want to think of excess returns in both the equity and the corporate bond market as being potentially nonlinear functions of, again, a measure of equity. We're going to be using the VIX, and a measure of credit spreads. In practice, because we're working with a very large panel of returns, we cannot estimate a non-parametric function in all of our return observations. And so instead, we're going to approximate this generic nonlinear function as a cubic polynomial in the VIX, credit spreads, and of course, the interaction terms between VIX and credit spreads. We're going to impose two restrictions on this expected excess return function. First, we're going to assume for parsimony that there are common coefficients within a country asset group. And second, we're going to assume that this nonlinear function actually has a flavor factor structure. So in particular, if we think about the full matrix of loadings on our full vector of the VIX, the credit spreads and interactions and powers between the two, we can think of it as having a factor structure that we're going to be estimating via reduced rank regressions. So the factors that we're going to be extracting from this procedure are the factors that I'm going to be focusing on. We're going to, in particular, focus on the first two components. You can, of course, think about extracting more components if you're trying to span more of the factor space. Just to give you some intuition for why we're doing things this way. So first, in terms of the nonlinearity assumption, from a theoretical perspective, if we think about the modern literature on intermediary asset pricing, we like to think of occasionally binding constraints for market participants. Occasionally binding constraints are going to translate into a nonlinear representation of expected excess returns. From a very practical perspective, there is a literature that shows that even for the US aggregate stock market, if you want to correctly measure the relationship between excess returns and the VIX, you have to allow for nonlinearity in that return. And so we want to follow that literature and actually allow for nonlinearities in our returns. In terms of why we're focusing on common factors, and in particular on two common factors, again, we want to think about global intermediaries as pricing global credit and global equity markets, but we do, again, want to allow for potentially different intermediaries for bond and equities. And again, kind of the stereotypical example would be thinking about insurance companies and mutual funds as pricing the bond market, and maybe more traditional intermediaries as pricing the equity market. In terms of the particular implementation, so as I've mentioned, we're going to be looking at a broad set of countries to extract these factors. In particular, we're going to be using 13 advanced economies, 9 emerging market economies. We're going to classify our bonds into, or our securities rather, into 4 categories. The safer bonds, so those that are rated above BBB rated bonds, high yield bonds and equities. Again, we're going to construct these factors to target 1 month ahead return predictability, focusing on bond level returns for the corporate bond market part, country level index returns for the equities, and we're going to impose standard filters on the bond market, and we're going to control for a battery of bond level and firm level characteristics when we estimate our bond level return predictability regressions. So to give you an idea of the time series of the 2 factors that we extract, one of which we're going to call the global credit factor, and the other we're going to be calling the global risk factor, is that, yes, of course, you have periods in time when both of those are going to be indicating tightening, for example, during the financial crisis and the pandemic. But importantly, we're going to have a lot of episodes where we have significant movement in the global credit factor, but not in the global risk factor. For example, during the LTCM episode in '97 and the Asian debt crisis in '98, and equivalently, we'll have movements in the global risk factor that don't correspond to movements in the global credit factor. So very quickly, again, just to give you a flavor of the return predictability results that we get. So here I'm showing you a subset of the 1 month ahead return predictability results at the bond level, again, for the bond portfolios, and equity index level for equities, regressed on our 2 factors, and again, controlling for bond and firm characteristics. And the way to read this table is that a positive coefficient on the global credit factor is going to correspond to tightenings in global credit, predicting higher expected excess returns. Instead of staring at all of these coefficients, let me show you a little bit about this flavor of the flight to safety. So again, one thing that we can show is that if you look at all of our country asset groupings and you order countries based on the volatility of year-over-year real GDP growth, we kind of see that the factor loadings are going to be higher for more volatile countries, and again, are going to be higher for riskier assets. Or equivalently, if we look at the coefficients ranked by the corresponding CAPM beta for both the credit factor and the risk factor, again, we get that the factor loadings from our return predictability regressions are going to be increasing in the asset beta with respect to the market factor for each market. As I mentioned at the beginning, we do have a lot of asset predictability results in the paper. I'm not going to take you through all of them, but I do think it's important to show you that the return predictability results are not driven by the global financial crisis, are not driven by the pandemic. So just to illustrate that, I'm focusing on the German BBB portfolio. As you can see in our full sample results, the global credit factor has a negative 2.72 coefficient. The global risk factor has a positive coefficient. And then just focusing on the global credit coefficients, we see that they stay consistently negative except for 2020. We know that there were a lot of government interventions in the bond market in 2020 that perhaps explain that change in coefficient. Whereas the positive coefficient on the global risk factor is only driven by the global financial cycle and the pandemic and the post-pandemic observations. Again, kind of highlighting the differential roles that the global credit and the global risk factors play in this. With my remaining time, I would like to show you some of the real activity predictability results that we have. So again, the first part of the paper focuses on documenting the global credit cycle and asset prices. We're now going to first think about the relationship between the global credit cycle and international capital flows, and then we're going to think about the relationship between the global credit cycle and local business cycles. So in terms of capital flows, we're going to focus on trying to predict capital flow events. The construction of the events data is fairly standard, so we're going to be using quarterly data on gross international capital flows disaggregated by type and the residency of assets. We're going to identify quarters of extreme capital flows as in Forbes and Warnock. And for what I'm going to show you today, I'm going to focus on stops, so a decrease in the flow of, in the capital flows coming into the country. Again, from a practical perspective, these types of event predictability regressions tend to be estimating using log-log regressions to account for the large number of zeros. And essentially, the only thing we're doing is we're augmenting the Forbes and Warnock specification with our two factors. Again, just to show you that in terms of stop episodes, we have that a tightening in the global credit factor corresponds to a higher probability of capital flow stops. I have highlighted with the red box the coefficients that are unique to our specification. And if we look at the full time period, we see that tightenings in the global credit cycle correspond to a higher probability of stop events across all flow types. But importantly, if we exclude the global financial cycle from our sample, which is what we're going to be calling the normal period, that predictability is going to be coming through the predictability of that portfolio stops only. And intuitively, that makes a lot of sense. We're looking at a factor constructed to price corporate bonds. And so it makes sense that the first place it's going to be showing up in during normal times is going to be in that portfolio events rather than events for other flow types. The second exercise we're going to conduct is to think about the relationship between the global credit cycle and local business cycle. We're going to implement that using local projections, but we're going to make things harder for ourselves by also controlling for not only local measures of the credit cycle, but also measures of the credit cycle at countries that are connected to the country we're looking at. And essentially, again, what we find is that first looking at the credit cycle in quantities, a tightening in the global credit cycle not only is going to predict capital flow stops, but is also going to predict decreases in the amount of credit extended in the economy, with the global credit cycle factor acting more in the short run, whereas the quantities of credit seem to respond to the global financial cycle more in the longer run. Similarly, we can look at the reactions of average real activity. So again, a tightening in the global credit factor is going to correspond to a near-term effect on growth, whereas a tightening in the global risk factor is going to have a longer-term effect on real GDP growth. And finally, the last exercise that we do is to think about the relationship not just for average growth, but also for extreme growth outcomes. And again, we find systematically that a tightening the global credit factor is going to correspond to increased probability of crises, which we define as declines in GDP growth, or year-over-year GDP growth less than -2%. And a longer-term effect of tightenings in the global risk factor. And so again, just to summarize, what we find is that with these results is that we have a local predictability of crisis, so crises at a country level rather than a global level, by a global credit price variable. The last thing I'm going to show you is that we can redo all of these exercises in an out-of-sample sense. Again, I'll just show you one of these pictures to give you an idea. And essentially, we're going to do a pseudo-out-of-sample evaluation where for each month in our sample, we're going to use the data up until then to estimate the factors, or estimate the factor loadings. We're then going to run the real activity predictability, let's say, looking forward. And so what I'm going to be showing you is essentially a time series of coefficients using these alternative vintages of the factor construction. And so, again, just to focus on the relationship with average real GDP growth, again, each point is going to correspond to the coefficient from one of these vintage regressions. And the interesting thing is that the global credit factor is going to have a stable relationship with future real GDP growth, whereas the relationship between the global risk factor and future and real GDP growth only has the expected sign between 2011 and 2018, when the original global financial cycle papers were written. So just to wrap up, what we do in this paper is investigate the central role of global credit conditions in macroeconomic cycles around the world. And what we argue is that there is a global pricing of credit, which then corresponds to aggregate changes in the probability of capital flow stops at a country level, which then translates into a global component to local credit cycles and local macroeconomic conditions. Thank you.
Thank you.
So thanks very much for inviting me to discuss this paper. Really very insightful. At the same time, it's also very ambitious, and I think you've already seen that from the presentation. We're covering quite a bit here. So I'm still at the moment of trying to absorb what is all going on, and hopefully my discussion will help a little bit, if not for myself, at least for you guys as well. So the question that the paper tries to address is, do global credit conditions affect local credit and business cycles? So we're going from the global to the local, and that's where the step sometimes can be quite quick and fast, because what it does is takes a formal asset pricing model. I'm not necessarily the asset pricing person, so I'm not going to comment that much on it, but what I read of it is it's all sensible, and actually is confirming many of the things that you would expect it to do. It takes that formal asset pricing model for a large set of countries, a large set of assets and bonds and equities to derive these risk factors that we typically kind of assume or somehow left implicit. And actually goes beyond that and looks at a global credit factor as well as global credit risk factors, so two separate, distinct measures of risk that we may sometimes aggregate into one and call that something like the global financial cycle. And then goes to the second step and asks, what does it mean for the local conditions? She calls that real. Actually, it's both financial and real in the sense it's capital flows, it's financial conditions, but it's also GDP and crisis. And there she finds that entire thing indeed predicts that it's the extreme events but where the innovation is also happening, right? So it's not that we have the medium there covered, we have the tail events that we're covering in the second part of the paper. So very interesting questions and a lot of praise here, relevant obviously. I mean, global financial conditions we know affects the real economy, but we, as I said, we're not always that clear about it. So here we have a rigorous asset pricing model. We're separating credit from risk. We allow for these non-linearities. It also takes a predictive approach. It's not like, okay, we see today something happening, there's a shock, and there's a shock at the same time somewhere else. No, there is a way of predicting here. So it adds both to value in the theory and as well in the practice. We've seen many papers. I've dabbled a little bit on the global financial cycle myself, and the literature has been growing quite a bit, but it's often without much formal structure, and my own work is definitely not with much structure. It's just looking at the data as they come along. And here we have a much more rigorous way because we have these developed risk factors. At the same time, I think in that some sense, that's why I call it ambitious. It's a little bit of a challenge to make that step, right? Because we have these asset pricing challenge both in the empirical sense for the paper, but maybe also in terms of placement, because we often talk to two different people, the asset pricing people and the more macro-oriented people. And this paper tries to pull this literature together. That is somewhat of a challenge. So that's my, in some sense, my main comment as well, that there's many moving parts here that the reader has to work through in order to link these things. So let me go step by step. The equity and bond excess returns are assumed to be based off the VIX and duration matches spread. That was not much discussed by Nina at a given time, but nevertheless, it's not an unimportant, innocuous assumption that you have to make at some point where are these risks being priced off. And in this case, it was the VIX and duration match, but you could have thought of some other variables as well. So then we go through these credit and risk factors, and we do the nonlinearities. The exposure mapping that she showed very briefly in terms of, call it the betas if you wish, they map up kind of with the country and the asset class as you would expect. So risky countries have higher betas, risky assets have higher betas as well. So that's very reassuring. At the same time, you find them also lining up with what we do in the simplistic way of like, let's use a financial condition index or let's use the LMRA index. They also line up with that. So if you really take it to the empirical level, then we're not adding that much value, but we have the more rigorous theory that we're doing it. So we need to make sure that the theory through which we add value is also going to be reflected in subsequent work. And there, I think the main component is the predictability, right? So in all the other work, it's typically we have this factor and it explains something contemporaneously. Here we're going to actually move to the predictability because it's a risk factor rather than kind of a contemporaneous way. But then in the second part of the paper, we're a little bit hampered by the frequency of the observations because we're not going asset prices, we're going to the real side, and of course then things slow down in terms of observation frequency. We're going to go to the quarterly, maybe even more crises that happen to come along once in a while. And particularly when we go to the episodes period, we have the handicap, it's one observation, so we're in the 0-1 literature, or in the recession literature, the same thing, 0-1. Or we have to look a little bit more continuous, but then we have to switch methodology. So we ended up with, in this case, a global VER or linear projections when we talk about the GDP and credit developments. So we're taking something both frequency-wise, but also theoretical-wise, to a different way of thinking and moving forward. So at least for me, I would like to see a little bit more laying out the steps that you do. That's just a presentation issue. That would help me as a non-asset prices person in the first place. But maybe, and this is going to be more an implicit comment for my next few comments, looking at the data that we're using, lines up along that logical chain of reasoning, so that we start with, okay, this is an asset price shock that affects an intermediary, or it's a credit shock, or credit shock affects the intermediary more. And that, for that reason, affects bond flows in the following way. And then the bond flows in turn affect something in the domestic receiving country. And as a consequence, I see developments both on the real or on the financial side within that country along that same line of reasoning. Because otherwise, if you're just going to go to the predictive set, you're going to end up with a little bit more of a disconnect between these two parts. I think it's feasible. I don't have it, however, in my comments yet laid out as to what exactly that would be. I think for sure, there's a lot of work that you didn't see in details, but in terms of building up those risk factors in the individual bond data that Nina and Leonard have used. And I think that is the way to continue on that comparative advantage in this paper to add to the global financial cycle literature. It's a little bit more implicit in my comments, and let me just run through them, and hopefully Nina will be able to extract more from there what she needs to do in the next version of this paper. So one, I'm always a little bit worried, but I'm also doing the same thing myself, so I should be careful here. US is typically taken as the core country and then saying things in the US affects the world, but at the same time we're going to be measuring everything in dollars, we're going to do the relative to excess returns, and then, hey, wait, the US is very important. Oh, hey, yeah, but you measure it relative to the US, so be careful on that score. Maybe you can do better there. Then this comment I made already before, get more granular, but you have a little bit of a disconnect here between the equity and the bond side. On the bond side, the paper used individual bond prices and used a lot of the bond specific information about the borrower, so the financial of the borrower, the size, and you name it. But then to control for it. But on the equity side, it's, if I understand correctly, it's more the general index where we don't control, of course, for all the specific firms that are in that index. So maybe that disconnect is okay, but I'm a little bit worried. More generally, I would like to see equity and bond prices in some sense doing jointly. That's a corporate finance problem more generally. We tend to think we keep them separate, but in the end, it's the firm value that is being valued. And that is also a practical thing, because once we go away from the big countries, so US, as I write there, 300,000 observations, 100 maybe for a small emerging market, small open economy. So you have a little bit of a disconnect there in terms of identifying it, and I suspect, but I can't tell that, liquidity must be an issue that hopefully you can take care of, particularly for the bonds, but maybe from the equities. So then when you move towards the second, it's predicting, but you have a relatively short horizon. So we have this high frequency data, and then we move to predicting capital flows, but it ends up actually being more or less a month or so ahead, which obviously for policy is way too late. But it's also something where I think in some sense you need the benchmark to be a little bit stronger established. What is the prior here? If I were to run a simple early warning exercise, early warning prediction, we may end up doing better or worse, but show me that. And then the data here is a little bit of a headache, because we move from high frequency to low frequency, end up averaging some of the high frequency shocks to get us predictive of what the kind of shock environment was in that one quarter, to gets us to the 1-0 capital flow measure. So I think your granularity on the bond and others would help you a lot to tell a little bit more. Now this sector, this country, this specific issue is being hampered, and that shows up in this particular flow. That's also why I think you should use the full spectrum of outcomes, not just the nonlinearity approach of the 1-0s, but take the whole ones. Related to that, I would not break down the capital flows always by type, or sometimes I would do more, sometimes I would do less. On one hand, you can argue that the whole flow should affect the real effects, because that's in the end, if I can substitute from bond to loan flows, then my country need not be affected when there is a shock in the bond market. At the same time, your granularity tells me to go the opposite way. go the bond flows very more granular and then show that that is happening. But now you take a little bit of the intermediate approach, and I think that may not satisfy either way. Data, always an issue. If you can go a little bit beyond December 22, but that's a lot of extra data, I'm sure, to collect. But then we know a little bit more what happens to the interest rate rise. A few things on presentation. So one, a flow of reasoning would have helped me. Show more explicitly the difference between the two credit factors. You allude to it, but show it too explicit. You talk a lot about extreme events, or you talk in the text and the charts, but show whether indeed these events are caused by the crisis. In some sense, it would be even more illustrative if you only take out the crisis and then say, well, look here, bang, the model works very well in this crisis and that crisis. You say it does, but I think actually you should make that part of the paper. There's a little bit more minor things. I think you can fix the charts and other improvements. I think maybe where I want to end up very last is on the quantitative importance. And this is just to promote my own work, I guess. But nevertheless, when we look at the global financial cycle with some work with Evgeny Cerruti, we do the simplistic one, but not as a pricey person. Well, I'm a simple person to begin with, I guess. And we look at the commonality in interest rates, house prices, equity prices, credit and capital flows. So that's the ranking there. The 75% commonality on our score, which is just an R-square score, and the 60% in housing and 40% in equity. So you see already asset prices have a lot more common movement, which is somewhat along the lines of what this paper shows as well. But then the other two is much more sporadic. The credit and capital flows don't have that same commonality. Now, how do we link these two together? There must be some conditioning factors here that make for certain circumstances. So I'm more exposed to that price factor at a given point in time or as a given country. Why? Because I have more international borrowings or I have more banks that are lending to me or I have weaker institutions. That differentiation can then tell me why I go from 75% or 60% down to 30 or 25% in the both, I would call the assets price side to the quantity side. And in many ways, what Nina has done in this paper is given us a very good intellectual and asset price based model to approach that question. I think now you can also quantify it, I think, much better. So let me stop here.
Thank you, Stein. Nina, do you want to react to one or 2 points of Stein?
Yes. So first of all, thank you very much. Yes, we know we have a lot of moving parts in the paper, and that's one of the things. Explaining how they all tie together is one of the things that we are trying to work on. One thing I want to highlight is that in terms of the comparison to, I don't know, like a measure of financial condition, standard measure of financial conditions, or the standard measure of financial cycles. When we look at either return predictability, which we can do very granular, or if we look at real activity predictability, our measures tend to outperform, and they tend to drive out these more standard metrics. And then I think it's a question of the application that you're looking at, the extent to which you can get away with doing a simpler approach and get some of the intuition, or whether you want to try to be more careful in measuring risk prices and follow the approach that we take. But again, thank you very much. And
thanks. Floor is open then. Jérôme.
Thanks a lot for the paper. Jérôme Henry, European Central Bank. I have some follow-up points in a way, as it appears, to the discussion. The first one is whether on the quantitative contribution at the country level, you add some information on the contribution of idiosyncratic parts. So what is global risk, what is global credit and what is the rest. So don't you have in some countries, for instance, where corporates are very much subject to sovereign shocks via their own risk premia, with something that comes on top, can happen in Europe in particular, also related to the discussion point on the US validity of the analysis. Then I'm wondering whether you had this information, or if you did not, I think it would be worth having for some countries in particular, non-US, the contribution. And the other thing is, to put it in a nutshell, the conclusion whereby if you have, like, going the other way around, not sure it's symmetric because you have no linearity, but looser credit cycle position would imply lower risk of crises going down the road, which is totally contrary to the early warning indicators, which is also using a predictive approach. So then my hunch on this would be, and would like to hear you on this as well, is that probably having the focus on the price rather than quantity things could be somewhat misleading, because at the end of the day, maybe credit would have its own dynamics relatively, or very even, independent of the commonality. Again, I think we have part of the answer, maybe, to what I'm saying now from the discussion. Thanks again.
Okay. Thank you. So first, in terms of the contributions between local pricing and global pricing of credit, right now we're not looking at the local pricing component in terms of the real outcomes. We do, of course, control for the local quantity of credit in the economy. Yes, we can try to also, we do have the data to also add a local pricing component. It was a judgment call in terms of how much complexity to add to the paper. In terms of the crisis predictability results, I think it is important to keep in mind not just the sign of the coefficient, but the horizon. So we know even from the local credit cycle literature that initially, while credit is expanding, you are actually predicting better outcomes. So this would be consistent with what we're getting. And in the specifications where we're controlling for both our factors as well as local and trade partners' expansions in credit, we don't get a lot of effect from the pricing factors in the longer term. We do get the standard coefficients from the quantities in the longer term.
I don't see further questions. No? Okay, then thank you very much again. And then Luc will close the conference.
Yes, thank you, Ulrich, and thank you all for being here with us. I wish you already very good sleep on the plane for some of you. I'm quite tired myself, which is either a sign of age or it's that the program committee did a very good job in selecting a bunch of very exciting papers that kept my brain working very hard. And I think that's where I would like to start. Thank the program committee, above all Bartosz, but also Laura, Melina, Colin, and Alex, and Justina for selecting all these wonderful papers and the keynote, above all. And indeed, Justina, I have to mention at least twice. Justina and Raquel are here in the back, and as you know, it's a bit like putting a movie together. The glory goes to the movie director, but you know, behind stage, it's someone else doing the job, and this year it was Justina. So thank you. Yeah, just like with movies, that's normally the movie credits, they will go, and at least sometimes I enjoy watching them. I won't hold you up very long. But it was indeed a long list of colleagues that helped this year, from communications, the multimedia team, the audiovisual teams. So we have Florian, Sarah, Anja, Nassar, Patrick, Kai, David, Martin, Jan, Thomas, Tony, Vera, Anna, Isabel, Federico, and Laura. I'm sure I forget someone. But indeed, all of them had different names. I think that's actually low probability. And then we have our beautiful trainees, the trainee students that had the maybe not so gracious job of going around with the mics. But I hope we'll make up with some good recommendation letters later in the year. So with that, it was a pleasure. Safe travels. Hope to see you back next year. Thank you.